data on inflation have been coming in a little slower. I wouldn't even say sticky or stalled. I would say the progress has just slowed.
The Fed has to reiterate its commitment to its inflation target.
I think the market at every step has been worried about inflation and has been rejecting these moves by having yields go up.
It's really about the bond market. So effectively, where people are starting to get nervous is from a positioning standpoint.
Big question to me would be, how high can these yields actually go?
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
From New York City, good morning for audience worldwide. This is Bloomberg Surveillance. Alongside Scarlett Fu this morning, I'm Anne-Marie Hordern. Scarlett, of course, John and Lisa, starting their holiday. We have the shortened week, but it's the final full week of 2024. And really, markets this morning, shortened week, kind of boring. No action.
Kind of boring because most of the big event risk has been removed, right? There is no government shutdown. That was resolved late Friday night. And the data that came in on Friday showing inflation was fairly subdued, also encouraged investors. So the picture right now for futures is pretty mixed, but I would expect that there would be a lot of window dressing, a lot of people buying the best performers of the year to close out the year.
How much are people actually also now preparing for potentially higher for longer rates of 2025 following the Fed, and also just recalibrating what 2025 will mean in terms of policy? We do have, though, M&A Monday, a big news coming out of Japan when it comes to Honda and Nissan. We are talking about now the third biggest auto manufacturer, these two companies combining by sales. How much of this is just preparing for the tough road ahead?
It's remarkable, the kind of numbers we're talking about here, because Honda will also buy back $7 billion of its own shares. You're seeing Honda shares moving higher in the pre-market. Those are the ADRs by 16.5%. Right now, it's a basic agreement for merger talks. They did hold a joint media briefing, and nothing's going to be really done until this new entity that will be listed by August 2026. So there's a lot of time for things to maybe go awry or a lot of details still to be ironed out.
The former leader of Nissan spoke to Manus Cranny last week, Carlos Ghosn, and this is what he had to say. He called it a desperate move by Nissan. He said it's not a pragmatic deal. Synergies between the two companies are difficult to find. The brands are similar, but for Nissan, this is a desperate move. Marry for short-term problems putting these two companies together. For Honda, it's really about a long-term vision. They can get bigger doing this, and I think they have more control of the board, so they're really in the driver's seat.
Well, they're not in the financial straits that Nissan is, and I loved what Carlos Ghosn said about how this deal lacks industrial logic and is probably a result of political pressure. We know the Ministry of Transportation or Industry Ministry has been pushing for a similar deal about 5 years ago that never came to pass, but this time around, Nissan is in a much weaker position, and it has perhaps no choice but to consider it.
I just wonder how many more we're going to see of these, especially when you look at what's going on in Germany and all of these just Chinese auto manufacturing companies coming out, can produce these cars cheaper, and it's a big story that's going to be for 2025. Coming in this program, Michael O'Rourke of Jonestrading with stocks snapping a 3-day losing streak. Bloomberg's Mike Shepard as Trump threatens to retake control of the Panama Canal. And Amrita of Energy Aspects on her outlook for the oil market in 2025. We begin this hour with stocks rising as traders boost Fed rate cut bets after cooler inflation data. Michael O'Rourke of Jonestrading is cautious, writing not only are stocks expensive in their own right, but they are also at the most expensive levels versus treasuries in 22 years. Michael joins us now. Michael, good morning, and thank you so much for joining us on this holiday week. Merry Christmas and happy holidays to you and your family. So if you think stocks are very expensive now, what are you doing? Are you selling?
I think you just have to be more selective. The S&P 500 equal weight trades at a significant discount to the S&P 500. So, of course, that expensive nature within the S&P 500, it's all at the top end in the mega cap stocks. And I think, obviously, we've had a tremendous 2-year run here. We have a new presidential administration coming in. You can expect a lot of volatility. So there definitely are numerous value stocks out there in the market and places you can invest. You just have to be a lot more selective. And I'd be, cautious about chasing the S&P 500 itself.
You talked about Trump in your note, and you said in the midst of the post-election euphoria, the equity market forgot that Trump is volatility bullish. Not only is Trump willing to break a few eggs to make an omelet, he will break a few extra simply because he can. Was the market reminded of that? Scarlett mentioned at the top of the show, we almost had a government shutdown. Was the market reminded of that last week?
I think it was. And I think people are starting to realize, well, a lot of the rally since the election has been this, we're going to cut spending, we're going to cut regulations, we're going to keep our tax cuts, and we're going to grow GDP. And, you go through this government shutdown or potential, we risk the government shutdown here. And you're like, you have to just remember there's a lot. It's not an easy path to achieve those goals. Those are great goals to try to achieve. I love it. It's ambitious, and I hope we do achieve it. But you're not. It's Washington, D.C. You're not going to get there in a straight path, and the market shouldn't price all that in right away, which is essentially what we've started to do in the equity markets. And what you're seeing in the bond market here is it's not fully believing everything that the equity market is excited about, and that's why you see the 10-year yield up above 4.5%.
Well, speaking of the market pricing in a lot of positivity, I look at Tesla shares up about 67% since election day. Elon Musk has really been a tailwind for the overall market through Tesla mainly. At what point does he become a headwind for the market?
Well, that's the interesting aspect. One thing I find interesting is Elon Musk has numerous companies, most of them private. He can benefit from his relationship with President Trump through any of those ventures as well. So for everyone to just bet on Tesla, which, you were just talking about the automotive industry, there's a lot of challenges out there. It seems like a really aggressive, myopic bet. So, going forward, I think people, again, they need to be a little more pragmatic out there and realize Elon Musk is an influential guy. He's a powerful guy. But it does, Tesla is not necessarily going to be the biggest beneficiary of Trump's Musk's relationship with Trump. And as we know, sometimes, these relationships President Trump has, they go through rough periods. Mm-hmm. So again, it's really risky to just bet on one stock to expect this bromance to continue.
Well, you mentioned Tesla. Of course, it is the low-hanging fruit here when you're looking at who would benefit from the Trump trade. When it comes to pragmatic approaches to challenges, I think about what's going on with Honda and Nissan, and Anne-Marie brought this up earlier, this as an example of the M&A that we can expect. From where the market sits, from where you sit, is this a pragmatic deal that has positive ramifications for U.S. automakers?
I'm not an automotive industry expert, but I do agree with everything you both said about this is a deal coming out of weakness. And we know all the weakness that's going on in Germany. And of course, their auto industry is key there. So you're looking at a situation where there are a lot of challenges out there in this world. And again, you don't want to see companies making deals out of weakness, but it's clearly that's what's going on here. So you have to think there's some risk out there.
When you look at the biggest risks heading into next year, obviously the auto industry is one of them. What else is on the horizon?
I just think it's the overall enthusiasm for everything. We've had such a speculative market. Bloomberg has this great article about the wildest trades of 2024. And you see that whether it's the leverage ETFs, some of these other speculative trades you're seeing out there paying these significant premiums to net asset value to some of these, stocks and ETFs out there. There's a lot of optimism built into this market right now. And it's not to say there's not things to be optimistic about. It's just when you start overpaying for them, you open yourself to this additional risk that, if there's a bump in the road, when you're priced for perfection, it can be pretty painful.
And the market right now is pricing in good policy from the incoming administration, this Trump trade. Yet, we haven't seen any of that policy yet. His term will begin January 20th. Michael, how are you thinking about the sequencing of next year when it comes to things like immigration, tax cut, and tariffs?
Well, I mean, that's exactly what I'm talking about. It's, translating these policy goals to actual policy takes a lot longer than the market's obviously pricing at this point in time. Anyone remembers the first Trump administration? He loves to negotiate. He loves to drive a hard bargain. He loves to push his opponents to the other end of the table. So it's not going to be pretty in trying to achieve these goals. So I think that's a key thing that the market's risking. So when you think of the sequence of policies you talked about, it's going to take time for all that to play out. And again, the market's tried to price it all in here in the span of 2 months.
Mike, I'm thinking about what's going on in the Treasury market. And on the long end, we've really seen yields steadily rise over the last 2 weeks. And there was some relief on Friday, but it does look like yields are inching higher once again today, and that yield curve continues to steepen. How does that set us up for 2025? Or do you kind of dismiss what we're seeing in the final week here?
I don't dismiss what we're seeing in the final week here. I do think the 10-year yield is so important because so many instruments price off that. The market prices off that. I mean, right now, the S&P 500 earnings yield is about 50 or 60 basis points below the Treasury yields, as we mentioned earlier. And so you're talking about stocks are more expensive relative to your quote unquote safe risk-free asset treasuries than they've been in 22 years. That just, is an example of the speculative fervor out there in the equity market. What happens if we see this 10-year yield continue to rise and test 5%? Equities will undoubtedly see selling pressure if that happens. Right now, I think this is a little bit of a crisis of confidence in the Fed in the manner in which they reversed course last week. There's also a little bit, obviously concerns about inflation upticking again and concerns about President Trump having inflationary policies. So if we see this 10-year yield continue to rise, you're going to feel that reverberate throughout all financial markets. So it's something we want to see stabilize here.
Yeah. What would be the catalyst that would send that 10-year yield to 5%?
Well, I think it's everything we've seen. Like you had the Fed last week, conclude a 100, basis point easing cycle while increasing their inflation forecast for the next 2 years. Basically, according to the forecast they released Wednesday, we'll run for above its inflation target for 6 years, which seems kind of ridiculous to be cutting rates when you're doing that. So that's one issue. Obviously, depending on how all these Trump policies play out, everyone's concerned that they're going to drive inflation, and that's a lingering fear. So treasuries have really been weak, acted poorly since just before the election. This was just the latest round of the sell-off, and like I said, we need to see them stabilize. If they do push up to 5%, the S&P 500 is going to have significant pressure on it.
Michael, what's your base case for next year in terms of Fed cuts?
I think, I'm going to go with the forecast at 50 basis points at this point. Although the Fed seems to change it every quarter. But I think we have a very strong economy. I'm surprised they cut rates as they did. GDP for this quarter is tracking 3%. GDP last quarter was 3%. When you think about the high rate environment the past 2 years, it has not slowed the economy. So when the Fed keeps saying we're restrictive, I'm not seeing it. You're not seeing the unemployment rate. It's 4.2%, which is basically at the Fed's long-run target. So it's really hard to predict what the Fed's going to do because they keep moving their policy goals around, and it doesn't seem to be tied to the movements within the economy.
So higher for longer in 2025. Michael O'Rourke
Sure.
of Jonestrading, thank you so much for joining us. Happy holidays and New Year to you. Let's get you an update on stories elsewhere. What else we're watching this morning? Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, Anne-Marie. The fight over spending in Washington is put on hold for another 3 months. President Biden has signed the stopgap bill that keeps the government running until mid-March. But the new law does not include a suspension of the debt ceiling that President-elect Trump demanded at the last minute. Republicans had abandoned an earlier bipartisan deal under pressure from both Trump and Elon Musk. Chinese automaker share of Europe's EV market dropped to 7.4% in November. That is the lowest level since March. Over that period, new tariffs were added after an EU investigation concluded that state aid provided China's EV industry with an unfair advantage. The tariffs added as much as 35% to the cost of importing cars. Meanwhile, Apple is considering a challenge to Amazon's Ring. The company is working on a smart doorbell that will have advanced facial recognition that wirelessly connects to a deadbolt lock. The idea being that the doorbell could automatically unlock the door for a home's resident just by scanning their face, just like Apple ID, letting them into their iPhone. And that's your brief. Anne-Marie.
Thank you so much, Danny. So, Scarlett, it's basically like Face ID, but Home ID?
In a manner of speaking, yeah. And this is a way for Apple to really expand that franchise of Face ID, but also to get more people to pay to subscribe to iCloud, which is a huge moneymaker.
Right, and I feel like Amazon's already ahead of them on this.
Oh, they are, right? I mean, Google and Amazon have been leading the way in terms of smart homes, and Apple's kind of playing catch-up.
Catch-up, exactly. All right, more on that later. Up next on the program, Trump's demands for Panama.
The fees being charged by Panama are ridiculous, highly unfair, especially knowing the extraordinary generosity that has been bestowed to Panama.
A lot of political fights already. It's not even January 20th. You're watching Bloomberg Surveillance. More on that coming up next. Welcome back to Bloomberg Surveillance. It is holiday week. Merry Christmas, just around the corner. This is the last full week of trading of the year, and you just see that S&P 500 futures flat. They were higher this morning, so now we're in the red. You know, red and green on par for Christmas this week. Euro taking another dip lower, now below 1.04. So many people, Scarlett, say actually. Analysts are saying next year, with the walls going up, we could see parity.
I know. I've been reading about that a lot. And of course, you had France with the political uncertainty there, and now Germany. So it's a little bit of a pylon. Dollar exceptionalism continues.
And New York crude under $70 a barrel. We're going to be speaking to Amrita on her outlook for 2025. Under surveillance this morning, Trump's demands for Panama.
The fees being charged by Panama are ridiculous, highly unfair, especially knowing the extraordinary generosity that has been bestowed to Panama, I say very foolishly, by the United States. This complete ripoff of our country will immediately stop. It's going to stop.
Here's the latest. Panama's president, Jose Raul Molina, is rebuffing President-elect Donald Trump's threat to reimpose U.S. control over the Panama Canal. Bloomberg's Mike Shepard joins us now for more. Mike, we feel like President-elect Trump is already having all these political fights before January 20th. Panama, Canada, Mexico, China, Greenland. Some of these we've already also seen the first iteration of Trump. Is he going to get anything out of any of these?
That's a good question. This is the Trump playbook. He offered Greenland as an idea during his first presidency. Hey, how about we buy this? And it was resoundingly rejected, of course, by Denmark at the time. And again, being very coolly received at best by the Danish government already. He'll put these ideas out there because they're on his mind, because he wants to keep people on their toes. And we saw this, of course, right at the start, not long after he won the election, with the challenge to Mexico, Canada, and China, the three largest U.S. trading partners, over the flow of migrants and drugs into the U.S. over the southern and northern borders. And he has already seen some effects from that. For instance, in Mexico, the crackdown is underway. President Claudia Sheinbaum there has reached out to Trump, spoken to him by phone. They had what both leaders called a productive conversation, and her government is trying to take some steps to address those concerns. Likewise, we've seen Prime Minister Justin Trudeau try to do the same thing on the border, even though the border really isn't nearly as much of an issue between the U.S. and Canada. But at the same time, he is paying a political price at home, and some of the threats on tariffs have really upset his coalition, caused some difficulties there. And then there's China. We see China moving to shore up its economy ahead of a potential trade war with the U.S. So we see lots of different countries responding in different ways already to Trump, and he hasn't even taken office yet.
He also talked about TikTok over the weekend, and he said, we did go on TikTok. We had a great response with billions of views. He then goes on to say, they brought me a chart. I'm guessing this is his team. And I looked at it and I said, maybe we've got to keep this sucker around for a little while. Now, TikTok is facing down this January 19th ban. What does it mean when the president-elect says he wants to keep the app around for a little bit longer?
Well, it does create the suggestion or the prospect that he may try to do something to perhaps slow enforcement or do something administratively to try to allow the app to continue operating in the U.S. However, there's a huge however there, Emery, and that is that there is a law passed by Congress, signed by the current president, passed by Congress, I will say, by a wide margin, with bipartisan support, that the app must be sold by its Chinese owners. Otherwise, it will be banned. The China-based company ByteDance does not want to let go of TikTok. It is a lucrative venture for them. And they also say that it would be very difficult to separate the algorithm that makes TikTok so valuable for it to be sold very easily. So this will be a tough problem for Trump and his team to try to solve if they choose to take it on. Now, TikTok does have one last chance, and that is at the Supreme Court. They are trying to overturn this law, as you know, and they have arguments scheduled on January 10th before the High Court in really a last-ditch legal effort to maybe change their fortunes.
Okay, so we have that to look ahead to in the new year. All of this invites the inevitable question, Mike. Where is Joe Biden, the current president and head of the White House right now? He's kind of absent in all of this. And I bring this up because I did see a headline on the Bloomberg terminal that says the Biden team is looking into investigating Chinese chips, which would then set up Trump for tariffs. I mean, it's an interesting move in that whatever they are doing, they know they can't get done right now in the remaining 30 so days. So they're kind of setting things up for the next White House.
That's right. And Scarlett, you bring up an interesting point about Biden. He has been ceding the stage in many ways to the incoming administration, perhaps more visibly than we've seen in other transitions. The last transition, of course, was quite rocky from Trump to Biden, with Trump essentially refusing almost to leave office and denying that he had lost the election, and then not really taking part in a lot of the official handover from his administration to the next one. So Biden is doing something a little bit different. He is, and of course, we have seen more and more his depleted state physically, and we have also seen how his priorities, we're seeing them take shape in the final days. He's pardoned his son, Hunter Biden, and he also does plan to meet one last time with Pope Francis at the Vatican. So he is making his priorities clear. One of those will perhaps be on the China front, as you said. They will try to launch this investigation if they can pull it off by the end. They have already put a lot of export controls to limit China's tech ambitions, especially in the area of developing and acquiring semiconductors, especially the advanced ones. And that will accrue to Trump's benefit and lay the groundwork for perhaps even tougher measures by Trump when he comes in.
Okay, so curtailing China's tech ambitions is one area on which the current White House and the incoming White House do agree. What else? What other issues, kind of fit that mold? What else could Joe Biden be teeing up Donald Trump for?
Well, one thing he could be teeing up very soon is the rejection of Nippon Steel's interest in acquiring U.S. steel. That is something both candidates really railed against during the presidential campaign. We know that President Joe Biden, who's a Pennsylvania native, very much opposed the sale to a foreign buyer of Pittsburgh-based U.S. steel. So it will be interesting to see how Trump responds to that and how quickly Biden moves. That will be one of the things we will see him try to take action on as he prepares to go out the door.
And this is one of those things, Mike, that they both agree on, that it should remain American-owned in U.S. hands. Bloomberg's Mike Shepard, thank you so much for joining us, and Merry Christmas to you and your family. Scarlett, you asked the best question. He is ceding the spotlight every single day. Yeah. The former president, who's already met with Emmanuel Macron, Volodymyr Zelensky, had countless calls with foreign leaders, and is already starting to shape potential trade concerns for 2025.
Yeah, Mar-a-Lago has become White House South even before his inauguration. And at every stage, it's clear that foreign leaders are thinking about how they're going to position themselves, how they're going to appeal to the incoming president.
One other issue that potentially we will see before this Biden White House leaves is sanctioning outright Russian crude. And that potentially could be a problem or a blessing for the incoming administration. Coming up in the program, speaking of crude, Amrita of Energy Aspects on her outlook for the oil market in 2025. You're watching Bloomberg Surveillance on this Merry Christmas week. Good morning. to Bloomberg Surveillance. The last final week of 2024. All the action in the markets was really last week. This is just that purgatory. Christmas week, New Year's week. If you're in the office, thank you so much for tuning in. S&P 500 futures are now lower. Last week, S&P 500 closed in the red for the week. Potentially might get another down week this week, Scarlett, heading into the new year.
Yeah, but it doesn't change the fact that it's up about 25% so far this year. So I don't know that we can read too much into it. Anyone who is long equities this year, they're pretty happy.
Okay, let's take a look what's going on in the bond space. We did avoid a government shutdown. We were very much on the brink of that shutdown. You had federal government agencies actually preparing what would need to be done if these agencies were going to be shut. And this year, what we have, if we could bring up the board, U.S. 10-year yield, 4.53. We do have, at 1 p.m., Scarlett, a 2-year bond auction.
Yeah, and there's plenty of demand for treasuries at the short end of the curve. There's also a 3-month and 6-month auction at 10 a.m. this morning. We've been seeing a steepening yield curve. A lot of talk in the past couple of weeks about what and how far the 10-year yield can go up, right? 5%, T. Rowe Price talking about 6%, which, seems a little high, but it's out there. And people are wondering whether this is something that's going to happen in 2025.
Yep, that's right. And in terms of what is going on in currencies, euro dollar this morning is below 1.04. Look at that, Scarlett. Pretty incredible. For 2024, the chart for me has just been this insatiable demand for U.S. dollar.
Yeah, the U.S. dollar has been on a real tear, up 7.1% if you look at the Bloomberg Dollar Index, near a 2-year high. It's only posted one down week since October. So that theme of American exceptionalism really reflected in the currency markets, technology leading the way, the economy growing faster than expected, unemployment being low, and of course, the incoming government being very, very pro-growth.
Right, and if you put tariffs up, that's only going to be stronger when it comes to the U.S. dollar, potentially weaker some of these other currencies. Under surveillance this morning, Israeli Prime Minister Benjamin Netanyahu vowing to act, quote, forcefully against the Houthis. This coming a day after a missile fired from Yemen struck Tel Aviv. Netanyahu calling on Israeli citizens to be patient, saying it may take time. So he's vowing to retaliate to this. Another interesting story also over the weekend from the Gulf involving the Houthis. There was some fire between the U.S. Defense Force and the Houthis, but during that, there was friendly fire, and 2 U.S. Navy pilots were shot down over the Red Sea. They were ejected. Thankfully, no one died in this incident, but you can just see what is going on with the fact that the Houthis still control the Red Sea.
Yeah, it's a reminder of the instability in the region. The U.S. has been targeting the Houthi rebels for over a year. And of course, the Houthi militia, which is backed by Iran, control a big chunk of Yemen, which has been striking ships to disrupt those shipping lines. And to just bring it right back to Netanyahu, of course, accusing the Houthis of threatening world shipping and the international order. So this is an ongoing story, shows no signs of clearing up.
No signs of clearing up. And they have been. And the U.S. military is there basically protecting the only vessels that are willing to go through the Red Sea, which at this point, I believe, are just Chinese and Russian vessels. Staying what's going on in politics, President-elect Donald Trump addressing concerns about the outsized role Elon Musk has had in his incoming administration. Trump saying Musk will not be taking over the presidency and calling such talks a, quote, hoax. Now, there's a lot of memes on X, which Elon Musk owns, about how it's President-elect Musk. A lot of Democrats are also really trying to play this up, trying to needle away at Trump. Trump had another funny comment to make and said, look, even if he wanted to be president, he can't, because he's not a U.S. citizen.
Yeah, and he added a ha-ha to all of that in the end. But it does raise an interesting question. It's something that we've all noticed, especially when you look at how Elon Musk's Tesla shares have performed since the election. Anything Elon Musk right now is huge. It's on fire. And this idea that he's kind of calling the shots, or at least being increasingly influential in national affairs. Just look at what happened with the almost government shutdown that we had, right? He was the one who got in the way and tweeted up a storm or posted on X saying that the Republicans should turn down and should vote down the Plan A, what ended up being Plan A.
He's also tweeted this morning, taking aim at not exactly Jay Powell, but at the Fed, saying the Fed has too many employees. And what matters now is why he tweets why we care is because he is now in charge of a task force that is looking at slimming the government.
But they don't actually have any legal authority, do they? I mean, it's not a formal government agency. It's like a blue ribbon panel.
it's going to give recommendations. And we'll see what those recommendations, maybe they're going to be targeted at the Fed. We'll have to wait until, I believe, the mandate comes up for them in 2026. Now, a top corporate story this morning, Honda and Nissan signing a formal agreement for merger talks. The automaker saying a holding company will be created to house the new entity and should be listed by August 2026. Former Nissan CEO Carlos Ghosn telling Bloomberg's Manus Cranny the move reflects the panic mode at Nissan.
It's a desperate move. It's not a pragmatic deal because, frankly, the synergies between the two companies are difficult to find. There is practically no complementarity between the two companies. They are on the same markets. They have the same products. The brands are very, very similar. So in a certain way, from one side, Nissan, it's a desperate move to try to find the future.
Carlos Ghosn there, fantastic scoop by Manus on Friday. Bloomberg's Craig Trudell joins us now. Craig, is he right? Is this basically, a desperate move by Nissan?
I think there are some, minor points that you can make to quibble with Ghosn's argument. You can point to the idea that, Nissan, for example, is really lacking in hybrids, and Honda can maybe help them in that regard. But on the large, I think he's absolutely correct that these are two companies that are relatively strong in Japan, relatively strong in the U.S., but really struggling in China, have an ever shrinking presence in Europe. They have a lot of the same strengths, but also a lot of the same weaknesses. And so if you're Japan, you want to come up with some sort of means for, putting a floor under Nissan. But how do you go about doing that? There aren't a whole lot of attractive options to do that. And also, I think there's a sort of, bias toward it being a Japanese solution. And so hence we're seeing this, flawed deal, coming together, or at least the broad outlines of it coming together.
So what's been interesting, Craig, was that we heard that Hanhai, also known as Foxconn, was interested in investing or maybe buying Nissan. How does that fit in with this eventual Honda-Nissan merger?
I mean, it really looks like that's going to be sidelined at this point. I think there was real concern, it seems, in Japan about the prospects for that sort of a deal, because it maybe sort of led to an acceleration of Honda and Nissan's conversations that have been, going back months. And I think there are perfectly legitimate reasons to be concerned, in the sense that Foxconn has been trying for years now to build up a presence within the auto industry. It hasn't really gained a whole lot of traction, so it's a very sort of untested player in this market. I also think that again, there's just a bias within Japan of, we want to protect Japanese interests, and if Hanhai swoops in here, not only do they lack experience, but they're a Taiwanese company with significant presence in China. Do we want to see a national company as big as Nissan end up outside of Japanese hands? And I think the answer within the Japanese government is going to be a resounding no to that.
Got it. All right, Craig, really appreciate your joining us. Craig Trudell covering autos for us for Bloomberg News in London. We want to shift gears now to oil, which is steadying, so to speak, after a weekly drop. Traders are weighing President-elect Donald Trump's threat to reimpose U.S. control over the Panama Canal. So joining us now is Amrita Sen of Energy Aspects. Amrita, we saw WTI drop 1.9% last week, and we're looking at Brent fall more than 2% last week. And, currently we've seen them on a little bit of a slide here. This latest comment from President-elect Trump about the Panama Canal charging exorbitant fees and wanting the U.S. to take that over. 2% of global oil supply passes through the Panama Canal. What does this kind of comment or this kind of instability for the region mean for oil prices?
I don't think it necessarily changes anything for oil prices overnight, because, again, we have to actually see what gets done, right? There's a lot of talk right now across everything, be it tariffs, be it Iran, Russia, U.S. production. But yeah, I mean, of course, if trade were to be disrupted, and we have seen that, by the way, over the course of this year, there were droughts, significant droughts that resulted in lower flows through the canal for natural gas, for LPG, though they are the two biggest ones that get affected. Oil less so, but but it just means that shippers will have to take the much longer route around Africa and to Asia essentially. So it's basically bullish for any shipping company, and it's bearish for U.S. LPG and gas prices. I don't necessarily think Trump wants that, right? But it does mean producers will have to discount the prices to accommodate for higher shipping rates because you have to take a longer route now.
Right. So it changes the cost input for a lot of the companies involved. When you look at crude overall, it's been trading a pretty narrow range since mid-October due to what a lot of people are calling lackluster demand and ample supply. When it comes to supply, is it simply ample, or is there a real risk that we're looking at a supply surplus that could persist for years on end?
No, I think that's the media narrative, the surplus that you just talked about. It's interesting that oil inventories across the board are actually very low. Oil pricing centers in particular, yes, we've seen some bills off late, but again, that's tied to kind of refinery downtime, which we see seasonally. And most importantly, OPEC has come out and very clearly stated they are going to delay the unwinding of the cuts to April, but also what they are, I think more importantly, what they have said is they're going to reduce the pace at which they bring back production over the course of kind of next year and through 2026. So that does take away the surplus for next year. I think now the market's shifted its focus. It was all about the surplus, but now it's shifting its focus to what Trump's going to do. And I think the belief in the market, rightly or wrongly, is that Trump wants low oil prices and he will get it no matter what.
Amrita, maybe there's no surplus right now, but there's a ton of spare capacity out there, isn't there?
Yes, and I think that's fair. And I think that's one of the biggest reasons why the market has struggled to rally, because ultimately, if spare capacity is high, by definition, even if you have low inventories, a lot of people will say that, oh, this is artificial. But what I do want to remind people is that where is that spare capacity, right? If the bulk of the spare capacity is in Saudi Arabia, a little bit in UAE, these are not countries that are going to necessarily put those barrels by cheating, etc. Right? I think that is very, very important, that if the spare capacity is concentrated and in the hands of GCC members, then it very much depends on OPEC policy, OPEC plus policy, whether it actually comes to the market or not. Regardless, we actually think sanctions on Iran will tighten up next year under Trump, and that OPEC will be able to bring back some of that production, which then means that spare capacity will be coming down.
So you think the Trump administration is going to take a harder view when it comes to that enforcement on Iran? I also have reporting that the Biden administration on their way out may actually start to outright sanction Russian crude. What can that do for prices?
Yeah, that's an interesting one, right? Because we've seen the current administration, the Biden administration, basically turn a blind eye towards sanctions, including, Russia, the price cap was never really enforced, but also including Iran. We've heard from multiple refiners where the State Department has said to them, it's okay to buy sanctioned oil. They're not going to, come under scrutiny. But now I think they are trying to turn the heat back on. Elections are done. Oil prices are low. Look, Russian oil, we didn't lose any Russian oil because of sanctions. India and China are buying whatever they can. We've only lost Russian oil because of OPEC plus policy. What I do think any direct sanction on Russia could do is tighten up a lot of availability in the East. We are already seeing lower Iranian availability in China, by the way, because of certain sanctions the Biden administration has come up with against Iran. So you're already seeing stronger demand for Middle Eastern crude, other crudes. So the Asian market is already tightening up, and anything they do on Russia will just make that significantly tighter, which ultimately just means higher oil prices.
So the expectation of that tightening might be driving hedge funds to take a more bullish view on oil. We see that hedge funds are becoming more bullish. Their net longs for WTI, for instance, rose the most in over 1 year, Amrita. How durable are these positions?
So this is the first time in a while, right? Like you say, hedge funds have actually turned bullish on oil. Throughout most of the year, they have been bearish. I think one thing we should not forget is that, yes, while we're talking about fundamentals, it is really the dollar, the yield, and also lower interest rates that are playing as big a part in determining oil prices these days. And what we have seen in our quant team, that it's actually the increased liquidity because of the Fed rate cuts that has allowed hedge funds to come back into this market long, just like they were were cutting their long positions and went short when the Fed had started to raise interest rates. I think that's been a pretty big driver. And yes, ultimately, if our view is right that you're going to get tightening sanctions and the market is going to be surprised, it's going to remain fairly balanced next year rather than being in surplus. And even though the hedge funds are along, by the way, the commercial speculators, which are basically the trading houses and a lot of the derivatives books in that kind of community, still hold a record short position. So there are still shorts to be covered. So I think hedge funds in some ways are probably ahead of the game a little bit. And if, again, January, February will be crucial to see whether we get the tightening of sanctions. If we do get it, then I think you will see some of these other shorts getting covered as well.
Okay, so we might see oil prices break out of their range that they've been stuck in since mid-October. It could very well happen. Amrita, thank you so much. Amrita Sen of Energy Aspects, really appreciate it. Let's get you an update on other stories elsewhere this morning and check in with Danny Berger for your Bloomberg Brief. Danny.
Hi, Scarlett. ECB President Christine Lagarde told the FT it is closer to reaching its 2% inflation target. She did warn, though, that they need to remain, quote, vigilant about services. Lagarde also expressed concern about trade frictions when President-elect Trump takes office, warning that retaliation is a bad approach that could harm the global economy. Donald Trump has named Stephen Moran to head his 3-member Council of Economic Advisors. Moran was a senior advisor at the Treasury Department during Trump's first administration. This summer, he co-authored a paper with Nouriel Roubini accusing the Biden administration of manipulating the economy via Treasury issuance. The Treasury rather vehemently denied those claims. NVIDIA reportedly plans to build an overseas headquarters in Taiwan. It favors Taipei City as its location, and it needs 3 hectares or 6 American football fields worth of land. CEO Jensen Huang had plans to increase investment in the country by building a large R&D center and hiring at least 1,000 engineers in the next 5 years. And that's your brief. Scarlett.
Thank you so much, Danny. Coming up next, traders are betting on more cuts from the Federal Reserve.
Most important thing for me was that we needed to recalibrate policy. Now I feel we've got that recalibration phase behind us, and we're in the next phase. And the next phase is really looking at the incoming information. We can return to a more typical pattern of gradualism for the Fed.
So we look ahead to the post-recalibration era. That's next. This is Bloomberg Surveillance. Good morning. This is Bloomberg Surveillance, and we're looking at futures, equity futures, fairly steady this morning. We averted a government shutdown. Steady in this case means a drop of 0.1% for S&P futures, although NASDAQ futures are poking higher just by a hair. Euro-dollar continues to be under pressure, off 1/3%, just under 104. In fact, so far this year, the euro has lost almost 6% against the dollar. It's just weakness after weakness, Anne-Marie.
And next year, everyone's talking about potentially parity. How much more difficult is it going to get for the euro? Fighting against not only the growth prospects they're dealing with, political paralysis, and potentially the walls going up with the United States.
Yeah, and that's why everyone's flocking to U.S. assets, although not necessarily to treasuries, especially at the long end. The 10-year yield has been elevated, and a lot of people talking about 5%, perhaps 6%. Oil prices not doing a whole lot at the moment after a weekly decline. Now, under surveillance this morning, traders betting on more rate cuts from the Federal Reserve.
Most important thing for me was that we needed to recalibrate policy. Now I feel we've got that recalibration phase behind us, and we're in the next phase. And the next phase is really looking at the incoming information. We can return to a more typical pattern of gradualism for the Fed. We have to remain agile. I mean, the thing that's got us here is being resolute to achieve our dual mandate goals. We have a variety of risks that are the ones we always deal with. My projection is that it will take many fewer rate cuts next year than we thought, but I'll watch the economy and see if that works out.
And here's the latest. We had muted inflation data last week that reignited hopes of more rate cuts next year after the Fed trimmed its forecast for 2025 to 2 rate cuts in the year. Joining us now is Deborah Cunningham of Federated Hermes. Deborah, we heard Mary Daly, the San Francisco Fed president, talk about recalibration and this idea that perhaps they're past that and they have moved into a new phase. She mentioned the word gradualism. Anne-Marie said maybe that's the next phase. We don't know. What does the Fed's next phase look like, whether it's called gradualism or anything else?
I think the gradualism is a good term, just simply because it's data dependent, and it seems as though the data dependency aspect of it is going to, sort of rule the day. And honestly, I think, given where we are from an economic standpoint, given where we are from a political changeover standpoint, I think the question is out there from an economy standpoint. And, inflation, you see two numbers that are either higher or kind of on the screws with expectations. And then our most recent information on Friday was a little bit lower than had been expected. So, there's glimmers of hope and then glimmers of despair. So I feel like that dictates, sort of the gradualistic approach that Mary Daly was talking about.
So you mentioned gradualism dictating everything and, data dependency being paramount at this point. The Statement of Economic Projections that the Fed released last week tend to be more important, especially in a day where everyone had priced in a 25 basis point rate cut, which is what we got. One thing that surprised me was how there was no consistency at all in whether the projections reflect the incoming administration's policies, right? Jay Powell said, some people did take a preliminary step. Others said they didn't. Others just didn't even specify. All of this seems really messy to me. Doesn't it make more sense for everyone to be on the same page? Why haven't they figured that part out?
Well, I do think it has to do with the inconsistency of what we're receiving on a daily basis from economic news. And certainly, if you looked at the information out into 26 and 27, it's a scattergram at this point. There is no consistency around where the voters are as to expectations for GDP, expectations for inflation, expectations for, where interest rates will end up. So I really do, allay it to the fact that the information that we're getting is not consistent. And depending upon who you are, whether you're a glass half empty, glass half full sort of person, you may interpret that data a little bit differently, which gives you all different expectations in the, not near future, but, I'll call the little bit longer term future.
Mohamed El-Arian this morning in the Financial Times, in an opinion piece, said that the Fed's flip-flops risk undermining U.S. exceptionalism. Deborah, do you agree?
I wouldn't call it a flip-flop. I would call it being in tune with your markets, being in tune with the economy. So, no, I don't agree. I think that the Fed would like to be consistent and always follow its, sort of pre-assigned path or, what its expectations are. But if the information, they rely on a feedback loop. And if that feedback loop is providing them with something different than what their expectations are, then I think they have to alter their plans. So being, I guess, responsive to the information that they're getting is more like what I would call it rather than, doing some sort of a flip-flop.
Deborah Cunningham, thank you so much for your time this week. Merry Christmas and happy holidays to you and your family. That's Deborah Cunningham of Federated Hermes. Scarlett, though, it's interesting because some members of the Fed said they were calibrating what next year might mean for Trump's policies, and others said, no, we're just looking at the data right now.
Yeah, and it really raises questions on whether they're all on the same page and how they're thinking about policy. I mean, it's notable that the last Fed meeting featured one dissent, right, from Beth Hammack, the incoming Fed president. It's going to reinvigorate the debate. It's going to make for a much different debate as well in 2025.
And she put out a statement saying that actually it's individuals in her district, the lower income individuals that are dealing with higher inflation, why she wanted to put that dissent out there. Coming up another hour, surveillance with Scarlett and I, Sarah Kunst of Cleo Capital, Terry Haines of Pangaea Policy, and Tom Steyer of Galvanize Climate Solutions, and of course, Clint Henderson, the man you want to talk to this week if you're traveling from the Point Sky. You're watching Bloomberg Surveillance. Good morning.
We've seen just such a frothy market over the last month.
I don't think the bull cases have gone away.
As the market broadens out, what that means is that the former winners are going to start to decline a bit.
Everyone's got a lot of uncertainty at the moment.
The next couple of weeks we think are going to get a little choppy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Welcome to the final week of 2024 from New York City for our audience worldwide. Good morning, happy holidays, Merry Christmas. This is Bloomberg Surveillance. Alongside Scarlet Food today, I'm Anne-Marie Hordern. Scarlet, keeping us company, Jonathan and Lisa have started their holidays early, left me here to hold down the fort with Scarlet. What we're seeing really is no action. It's Christmas week, but what a year it's been. S&P 500 up some 20%. And now, looking into next year, the questions on the horizon about the Fed and about policy. I love what Stuart Kaiser put out yesterday, Scarlett. He talked about positioning and policy risks, drove a 120-minute sell-off to define the week. How many more of those potential 120-minute sell-offs can we see in 2025?
That's a really good point. The 120-minute sell-off was violent, it was stark, it was deep, it was big, but the days where we recover are kind of forgotten, right? I mean, it's just a slow melt up. And the slow melt up has resulted in prices that have priced in great scenarios for everything, where most investors are giving the president-elect all the benefit of the doubt and not really thinking through perhaps the ways in which things can fall apart. We almost had a shutdown last week, but it was averted.
We almost had a shutdown. Third time's a try to get that deal through. Actually, I was in D.C. Federal agencies start to take all the precautionary measures they need to take in order for those shutdowns. Can you imagine what a shutdown would have meant into January around the holidays for the FAA? Things like TSA, they do get paid but delayed. So what ends up happening is a lot of these workers start calling out sick.
Yeah, and especially during the busiest travel week of the year. I know we're going to speak with Clint Henderson of The Points Guy a little bit later on about what that would have looked like. Fortunately, we'll just deal with the usual holiday travel mess.
Right, and if you're traveling this morning, very good luck to you. I did it over the weekend. It's not exactly always that much fun. This morning, as Scarlett have been saying, S&P 5 futures are flat. The S&P 500 last week closed down on the week. It was a tumultuous week when it came to trading because of the Fed, because of PCE. Coming up this hour, Sarah Kunst of Cleo Capital, as stocks come off their worst week since mid-November. Terry Haines of Pangaea Policy as President-elect Trump addresses Elon Musk's growing influence, and Clint Henderson, as Scarlett said, of The Points Guy on the state of holiday travel. We begin this hour with stocks higher. The S&P 500, actually they're a little bit lower. S&P 500, NASDAQ pairing Fed-induced losses on the back of subdued inflation data. Sarah Kunst of Cleo Capital anticipating a big year for deal making, saying we're in a market that has done well over the last year and people have plenty of cash on the sidelines. IPOs are going to happen. M&A activity is also likely to pick up even faster with a defanged FTC and SEC. So look at Mag 7 to take their seemingly endless piles of cash and go on a shopping spree. Sarah joins us now. Sarah, thank you so much for joining us this holiday week. So where do you think they should go shopping?
I think that AI is going to be one of the top places that they're looking on their shopping list, because the reality is, and we've already started to see this with Microsoft, a lot of AI startups have been funded in the last couple of years. And what people are quickly realizing is, wow, it is expensive to keep funding them, to keep scaling them. And these big companies, they need the win. They need that innovation. So I think that you're going to see a lot of tie-ups there that just haven't been possible over the last couple of years because it has been a really sort of anti-M&A environment.
So how much of this is driven by change of leadership in Washington, D.C.?
I think that certainly some of it is. Some of these companies were going to need to go out anyway. When you look at the IPO market, you see companies that in that sort of dip in 21, 22, they raised capital on terms that had covenants that said, hey, you really need to go IPO quickly because we are going to make it very painful for you if you don't. I think ServiceNow had some of those. They just went out, seems to be doing, okay. And so I think that we're going to see companies that had to IPO anyway, and now they're sort of, hey, it's not the right time, we're not going to get great returns for you, kind of, feedback to their investors isn't going to hold as much water because we do have a new administration coming in that has indicated that they're going to be a lot friendlier to IPOs and a lot less hands-on the regulatory.
You know, I think about how last year at this time, investors were waiting on some prominent companies to go public, Sarah, notably Reddit. And of course, Reddit did go public in March and has had a tremendous run. Are there any big names on deck for 2025 that people are anticipating with the same excitement that they were for Reddit?
Look, people have been anticipating Stripe to go public, and that might continue. We might have to keep anticipating, but that's certainly been names that people have been salivating over for a while now. I think Klarna is going to be another relatively bright spot. You have to remember that these companies have already massively repriced themselves down because they were raising in the private markets at valuations that were just totally out of whack with what their public market counterparts were getting. And during that downturn in 22, a lot of them had to do some really hard internal private repricing, which makes them a better target to go public because they're not sort of so unaligned with their public market comps anymore. And of course, the like $500 billion elephant in the room is SpaceX. You know, will we see some sort of public market transaction there? Probably not the whole company, but potentially with parts of it. Elon always needs more cash. And so, you know, there are some really big names that people in the private markets are betting on to go public soon. And those are some of the same big names that people have been betting on to go public in the private markets for a couple years now. So we just don't know until they file.
I love that. The headline of the hour, Elon always needs more cash. Sarah, you talk about cybersecurity being a big theme for you in 2025. In what way? As companies that will IPO or as targets of M&A?
You know, I think that we're going to see a lot of activity everywhere. The internet is getting basically unusable for people. You know, I use a bank where I literally can't send wires. I have to call them to get wires sent. And this is a huge wealth manager in the US because there's so much fraud that they say, look, it's just better if you don't touch it. That's not a way to live. That's not sustainable. And so what I think we're going to start to see is a lot more consumer companies focused on cybersecurity. That's an area that historically everybody said consumers won't pay to stay safe on the internet. But, you know, you kind of have to at this point because everyone's losing money to scams constantly, and there has to be some sort of recourse. And so I think across consumer, across defense, you know, even infrastructure, we're just going to see a lot more. At the really early stage, Cleo Capital, my fund, we actually launched a cybersecurity accelerator because we want to put our flag in the ground and say, look, startups, you don't have to just build for enterprise. You can build, you know, across the spectrum because everybody deserves to be able to go on the internet and use it and not immediately get scammed. And we know when Bitcoin goes up, when crypto goes up, we tend to see even more scams because that ransomware money is a lot more lucrative. You have entire countries that are funding huge swaths of their nuclear programs with ransomed Bitcoin. And so I think that cybersecurity is going to be really big. The names that we know, like Palo Alto Networks, I mean, they knocked the entire internet offline and they're still doing relatively well because people need their products. And so I don't think that that's going to go away next year.
Right. That's a good point. I mean, the big cybersecurity companies have all taken a few knocks, yet people still see blue skies ahead for them. What kinds of companies will they be looking to buy versus those that maybe they would form partnerships with? How are you thinking about that?
Yeah, I think when it comes to the M&A piece of it, they're going to be looking for ways to get a lot of times just new customers. You know, what you need to do to have good cybersecurity starts to get into what you need to do to never, ever, ever use your computer, right? If you have 25, you know, character unique passwords for every service that you sign into and you change them every quarter or every month like you should, you never have any time to get anything done on the internet. And so I think that there's going to be a push for how do we make cybersecurity sustainable, usable, workable? Most failures happen because an individual decides, hey, I don't need a password, I won't lose my laptop, you know, whatever it is. These are human factors. And so how do you sort of make it easier for the average human, for you and I, to not, you know, accidentally expose our company or our bank account or a social security number, you know, to these bad actors? And so I think that companies that really understand the consumer side of it are going to be incredibly attractive to these companies because we have this sort of encryption technology. We know how to keep things safe. The problem is it's really, really hard to keep things safe when it creates such a huge onerous burden on the end user that we all end up throwing up our hands and saying, hey, whatever, password's probably a perfectly good password.
Sarah, how much of this is also a concern for the U.S. government, especially when it comes to state actors?
I mean, the US government has come out and said, hey, don't use SMS, right? And you're like, no, but that's a text message. Yes, that they're saying it needs to be encrypted end to end. You need to look at services like iMessage, like Signal. Sending an SMS is broadly, you know, with the recent Chinese attacks on sort of everything, you have to assume that your texts aren't safe. And so it's certainly, you know, a defense problem. Both in the sense of just governments that spend a lot of time and effort, you know, hacking and, you know, a lot of the big sort of, hey, you get a pig butchering scam message from somebody hits you up on a dating app who's maybe a little too cute for you and all of a sudden wants, you know, you to help them trade crypto. A lot of that kind of stuff is coming from government actors, and they're using that to make up for sanctions or wherever else they don't have cash. And so this is a problem across everything you could think of. When you're home over the holidays this year, look around at your aunts and uncles, your grandparents, ask them if they know anybody who's gotten scammed. And you see how many 70 and 80-year-olds in America are getting scammed and know people who are, you realize this is a gigantic problem.
So IPOs, cybersecurity, what else are you looking for 2025?
You know, I think that we're also going to see a lot of money going back into startups. Not that it's slowed exactly. We've certainly had a huge amount of that happening in AI. But when you look over the rest of the broad startup market, there's been a slowdown because, you know, investors, big venture funds haven't had those returns coming back. So as those returns come back, and also a lot of venture funds now do hold different crypto, different tokens, you know, Bitcoin. So as those asset classes heat up, I think what you're going to see is a lot more money going back into startups. And so, you know, later stage startups, the series B and C, I think are going to be really, really hot. I think that we're also going to see a little bit of uncertainty at the beginning of the year until the tariff situation gets straightened out. But once people have a sense of what's going to happen there, I think anything that's not directly impacted by any tariffs, you're also going to see a lot of growth. I think that the AI trades, particularly in the Broadcoms and Intels of the world, are far from over, those legacy tech names in the public markets. And so I think it's going to be more of the same, but it might feel even faster paced and more like the last few weeks and the last few years, just given the fact that there's probably going to be a lot more money coming off the sidelines and into investing.
Sarah Kunst of Cleo Capital, thank you so much for joining us. Merry Christmas, happy holidays to you and your family. You know what else is going to be a theme for next year, potentially? I think we're seeing it already, consolidation in the auto sector.
Absolutely. Nissan Honda signing the basic outline of a merger agreement where things will really get going by January of 2026. You can see Honda's ADRs moving up by 16%. I was just looking at some old stories, and it was interesting to see that Nissan officials, unnamed Nissan officials, were saying in late November that they have 12 to 14 months to survive. So they were kind of on the prowl already, looking for some kind of white knight, a savior.
Absolutely. And Nissan's former boss, Carlos Ghosn, talking about how really this is just survival mode, last-ditch effort to try to survive for Nissan. We'll have more on that story. We're also getting an update on other stories we're watching this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, Anne-Marie. Alleged United Healthcare CEO shooter Luigi Mangione arrived back in Manhattan after being flown in from Pennsylvania by the NYPD. Mangione was escorted by a group of officers accompanied by Mayor Eric Adams. He's currently being held at a detention center in Brooklyn, and he's set to appear in court later today for his arraignment on state murder charges. He's also been indicted on federal charges, including first-degree murder, which could make him eligible for the death penalty. Xerox announced it will buy Lexmark in a deal valued at $1.5 billion, including debt. The acquisition would return Lexmark to U.S. ownership, and it would help Xerox with global expansion as it struggles with sales. Xerox expects the deal to close in the second half of next year. It says that Lexmark would immediately add to its EPS and free cash flow. And at the box office, Paramount's Sonic 3 took first place in the weekend, netting $62 million in North America. The popular video game franchise easily beat out Disney's Lion King prequel, Mufasa. It earned $35 million. Wicked, that hovered in third place with a total haul of $384 million in the domestic box office after 5 weeks. And that's your brief, Anne-Marie.
Thank you so much, Danny. Scarlett, have you seen any of those movies?
No, I did see Carry On, which was on Netflix, so it was a little bit of a waste of time, but interesting enough.
I saw Gladiator too. To be honest, the original was better.
Yeah, well, the original is kind of untouchable.
Yeah, and there were sharks, in the Coliseum, which just for me is so unrealistic.
It's a bridge too far. Everything else was realistic,
Yeah,
but the sharks.
not really, but yeah, it was a bridge too far. All right, up next, setting the record straight.
All the different hoaxes, and the new one is President Trump has ceded the presidency to Elon Musk. No, that's not happening.
President-elect Musk, not happening, according to President-elect Trump. You're watching Bloomberg Surveillance. Good morning. Under surveillance this morning, setting the record straight.
All the different hoaxes, and the new one is President Trump has ceded the presidency to Elon Musk. No, that's not happening. But Elon's done an amazing job. Isn't it nice to have smart people that we could rely on?
Here's the latest. President-elect Donald Trump addressing concerns about Elon Musk's influence in his administration, adding the Tesla CEO cannot be president because he wasn't born in the United States. Terry Haines of Pangaea Policy writing Musk has emerged as a liability to Trump in at least 3 ways, U.S., U.K., and Germany, that imperil Trump's economic and geopolitical actions. Terry joins us now. Terry, thank you for taking time out of your morning this holiday week to join us. So how much of a liability do you really think Trump is right now? And potentially, is he overstaying his welcome? Is this getting to President-elect Trump?
Well, I think, Anne-Marie, that it's a matter of what he does, how he does it, and how visible he is. And, Musk getting way over his skis on a whole bunch of things is bad for Trump. One of the things that Trump does quite often is, gives people rope and sometimes gives them too much rope, and then has to reel them in, and has to clean up the mess after them. I think that's largely what's happened with Musk. As much as he came out late last week and made federal spending much more difficult to come by, he disappeared rather quickly. And so I think it's a matter of kind of calibrating how and where he's going to be most effective. But I do expect him to continue to be around for a while.
Let's talk about the shutdown debacle, because we could have been having a Monday morning right now with the government shutting down. We were on that trajectory. What episode did that tell you basically over how Trump is going to deal with Republicans in Congress, especially the House?
Well, he's got a job to do in putting the toothpaste back in the tube, and it probably won't be perfect and maybe not done at all. The last thing Trump needed with such small Republican majorities is the kind of incident that happened last week, and yet it happened. So he's going to have to spend more time making it up to Congress rather than Congress making it up to him. You can't be in a situation where you're treating a co-equal branch of government. That's what Congress is, and more importantly, that's what they think of themselves as. You're treating them as if they can turn on a dime. Do 180s on policy positions that many of your own party have been taking for 20, 30, 40 years. And when you don't get that fealty, threaten to run them out of office. That's going to be a job, that's going to be quite a cleanup job, and it's going to involve the president personally. It's going to take a little while. Meanwhile, it's going to delay all kinds of things, from how to deal with the debt ceiling to the tax bill itself.
So I want to go to that idea that there was a small handful of Republicans in the House who defied the president-elect. 38 Republicans who voted against Mike Johnson's Plan B funding bill that was backed by the president-elect before moving on to Plan C. What does that portend for how the House will or will not comply with what the president-elect is seeking?
Well, two things, Scarlett. First is that if you've got 38 members of your own party that are willing to defy you without any compunction, I mean, they just, went right ahead and did it. You have, twice as many, 3 times as many, 4 times as many who actually think what they expressed. So that's one reason why I say that it's much more difficult. It's a much more difficult situation than may be apparent just by the votes. Secondly, after all this, I continue to say that I think the tax bill is about 80% likely today, although that's volatile. The reason why is very simple. Congress wants the tax bill, and Congress gets to write the tax bill. Just like in 2017, Trump doesn't get to write the tax bill. Congress gets to set the parameters and deal with the specifics. And Trump's influence is limited to, frankly, some things he might want in the bill, some things he might not want in the bill. And, whether those things are doable or not, frankly, is much more up to Congress. And they will be marginally more willing to defy him on many of those things, whatever they might be down the road. But the tax bill is going to take a while, and it just took a little bit longer, thanks to what Musk did last week.
Yeah, well, speaking of the damage that Musk might have done to the president-elect's agenda, you mentioned that Musk has been a drag on U.S.-UK relations. How much time does Trump or his team need to spend to kind of clean up the mess here as Elon Musk puts the U.S. in an uncomfortable position?
I'm not sure I've seen a situation where the relationship between allies, particularly between the United States and another one of its serious allies, has been upended and shaken quite as much as the U.S.-UK relationship has been over the last week. That's happened on both sides of the pond, by the way. Musk offering to back Farage's Reform Party to the tune of 78 million pounds, I think it is an indication that Trump himself thinks that the existing political parties in the UK that he has to deal with are somehow not worthy of being dealt with. And so that's a problem. But, on the other hand, the UK Prime Minister Starmer's made a bunch of messes here, too. Firstly, sending Lord Mandelson to Washington when Mandelson is well known to loathe Trump and Trump loathe Mandelson is a bad sign for the U.S.-UK relationship. And then Starmer also seems to be, and Mandelson seem to be outsourcing policy to some extent to Farage by Mandelson saying that Farage can be brought in order to help with Trump. So the UK's now got a situation where it might have dueling ambassadors in Washington. Mandelson living in the mansion, but Farage actually being the conduit to Trump. This all around is an untenable situation, but it's going to take a while to shake out.
Yeah, it sounds like it's pretty messy diplomacy in the meantime. So, Terry, it's the last week of 2024. It's a holiday week. We presume things will be quiet, but this is Trump world we're talking about here. What's a headline that you're going to be anticipating or bracing yourself for this week?
Well, not so much bracing, but, a lot of what let me run a thread through a lot of things that you and Anne-Marie have talked about this morning. What do the Panama Canal, Greenland, Canada, and the Honda-Nissan tie-up all have in common? I would tell you what that has to do is U.S. defense and U.S. national security. In Trump's kind of, sometimes clumsy way, what we're talking about here is a situation where, he's very interested in drawing a United States defense perimeter, both in the Atlantic and the Pacific, since the canal goes through the Pacific. And the Nissan-Honda deal is only the latest of the indications that the West is going to have to fight back against China's desire to dominate sectors and subsidize.
Good point, Terry. Thank you so much for your time. Merry Christmas, happy holidays to you and your family. Terry Haines of Pangaea Policy. Coming up next, Tom Steyer of Galvanize Climate Solutions. This is Bloomberg Surveillance. Good morning.
Good morning. This is Bloomberg Surveillance. I'm Scarlett Fu with Anne-Marie Hordern. John Farrow and Lisa Abramowitz are taking a much-deserved break for the holidays. Let's get you an update on where things stand right now, because after 2 straight weeks of losses, the S&P 500 right now indicated to move higher at the open, but it's early days, and this is a modest gain here. NASDAQ futures also higher by 0.4%. Small caps under pressure. There are some catalysts later on today. We've got Chicago Fed activity and durable goods at 8:30, building permits before that, and new home sales at 10 a.m. Treasuries. Anne-Marie, you reminded me, there's going to be a debt auction today.
There is going to be a debt auction today. Yeah, that's right. So we have at 1 p.m. 2-year bond auction. This is what Lisa would start the show with. So, in homage to her, we have to talk about what's going on. But of course, Treasuries this morning, I mean, really no drama here because there was no government shutdown.
There was no government shutdown. That was averted.
We could have had a very different Monday morning.
Yeah, but yields continue to move up, and that's been the story for a while now, right? On the long end, yields have been steadily rising over the last 2 weeks. A lot of talk about 5%, maybe even 6% in 2025.
At some point, if we were to see a 10-year yield at 5%, 6% if potentially what you're saying becomes true, how much is that going to push back on some of the potential fiscal policies that the incoming Trump administration want to do when it comes to things like tax bills?
Yeah, well, it's definitely going to increase our interest management expenses, so that's a big part of it. Just a quick glance at euro dollar as well. Euro under pressure versus the U.S. currency. The dollar has been on a tear, up 7% so far this year when you look at the Bloomberg Dollar Index. And again, we continue to see the euro weakening, and a lot of talk about parity perhaps being next, but clearly the euro direct victim of this threat by President-elect Trump to impose tariffs on the EU for this time not buying enough U.S. oil or natural gas.
Right, that's the latest one. But what's interesting is that right after Trump won, Ursula von der Leyen came out and said she had a phone call with President-elect Trump and said, maybe we will just buy some more LNG. The U.S. is already shipping tons of LNG to Europe, but they are also still buying LNG from Russia. So potentially more LNG from the United States could go to Europe. That is how Trump is going to try to enact deals. It's going to be very transactional. White House.
We've seen it before, and we'll see it again for this second go-round. All right, we are 2 hours away from the start of U.S. trading. Let's get to your morning movers now with Danny Berger. Danny.
Hey, Scarlett. As he tends to do, Warren Buffett moving some equities this morning. On Friday, we learned of some purchases that Berkshire Hathaway had made, the most surprising of which was probably Occidental. So these shares rallied on Friday. It's happening again today, up more than 2.5%. Why surprising? He's sitting on a paper loss on this equity since he started buying shares of it 2 years ago. Now he owns nearly a third of the company, maybe a sign, and at least the market's taking it as such, that he is more confident in leadership. Meanwhile, Eli Lilly also rallying this morning, also off the back of late Friday news. They have one FDA approval for their Zepbound shot, that is the weight loss shot, to be used for sleep apnea. This is the only drug on the market that's approved for sleep apnea. Everything else is more mechanisms, not really drug-type treatment. Now, they say it works because of the weight loss that it causes. But this is good news, not just because of a bigger addressable market for sleep apnea, but this might help them get more insurers to cover it. That is the holy grail for Eli Lilly and helps them more compete with Novo Nordisk. Finally, just wrapping things up with Qualcomm. Qualcomm had been in a lawsuit with ARM. ARM had been alleging that Qualcomm violated its terms of agreement, that it was incorporating tech without paying a higher licensing fee because of a startup Qualcomm did. Anyway, Qualcomm has won that lawsuit. Shares up nearly 3%. ARM, for its part, though, says that it will seek a retrial. The judge saying it is very well within the right to do so. Scarlett, back to you.
Thank you so much, Danny Berger, with our morning movers. We'll check in with her a little bit later on. Under surveillance this morning, Honda and Nissan taking their first steps towards a merger. They signed a basic agreement for further talks. A holding company would be created to house the new entity, should be listed by 2026. Anne-Marie, this merger would create one of the world's biggest car makers. It would compete with Toyota, the #1 car maker in Japan, and also Chinese EV automakers. And that's a big one.
And that is what is driving this, and potentially why we could see more consolidation, job cuts, CEOs going, because of what is going on in the auto space. This is going to create the world's third biggest automaker by sales. I go back to what Carlos Ghosn told Manus last week as rumors of this deal were coming out, and there was reporting that potentially there was going to be a tie-up. Carlos Ghosn said it was a desperate move, not pragmatic, didn't really see the synergies between the two companies, found it difficult to find, said the brands are too similar. For Nissan, it's desperate. For long-term vision, though, for Honda, potentially it's going to be good because they're the ones that are going to be in the driving seat.
What's interesting here is that the Trade Ministry of Japan actually first proposed this some 5 years ago. Nothing came to pass. But now, with Nissan under further financial pressure, it becomes a necessary step to take. Elon Musk, this is another big story. He's always a big story these days, writing on X that the Federal Reserve is, quote, absurdly overstaffed.
He has a view on everything.
Yes, he does. And of course, he says this from his position as co-head of DOGE, right? Department of Government Efficiency, once January 20th comes and goes. Although this is not a clear-cut government agency. He doesn't actually have authority to do anything about this beyond talk about it.
That's right. This is just basically a task force. So he has a task force along with Vivek Ramaswamy. They're going to offer up ideas to Congress, but Congress has the power of the purse. What is so interesting about Musk, though, because I tweeted something the other day about something he tweeted, and someone said to me, I'm a U.S. citizen that pays taxes, and I tweet, why don't you care what I have to say? Well, because of his proximity to power, to President Trump, and also for the fact that he's going to be leading this task force. Even if it doesn't have the teeth and some of the capital it would need to actually do the work, it is going to offer up ideas to Congress and to the administration. He took aim at the Fed, though, this time, something that President-elect Trump did recently, talking about how it's the easiest job in the world. I went back and looked. The Fed employs 24,000 people. Elon Musk thinks potentially he could, scrap some of those people.
I like how even Elon Musk needs to play to what Donald Trump has already said, which is, you mentioned that Trump made the comment about the Fed job being the easiest job, and Elon Musk was like, that's a good target. I'm going to target that one next. All right. Trump also threatening to reimpose U.S. control over the Panama Canal in a series of Truth Social posts, calling its shipping tolls ridiculous and saying that its sovereignty is not negotiable. The president of Panama, of course, firing back, as you'd expect, saying the canal is, quote, part of Panama and will continue to be. And a big part of this, Anne-Marie, as part of our theme, goes back to China, because China has a pretty big role here in the Panama Canal.
Yeah, Terry Haines nailed it. China doesn't control the canal, obviously, though, through a Chinese company, has 2 of the 5 ports adjacent to the canal. Also interesting, China influence has been growing in the region. We've seen that. And in 2017, Panama severed diplomatic ties with Taiwan and declared that there was, quote, only one China. So potentially, this is actually Trump's concern about China's influence in the region, and less so about what's actually going on in the Panama Canal.
All right, we will continue to monitor these headlines for you, but we want to stay with what's going on in Washington, because the current administration, the Biden White House, is setting an ambitious pledge to cut greenhouse gas emissions over 60% by 2035. Now, whether that's feasible is obviously in question, with Donald Trump set to dissolve U.S. climate regulations. Tom Steyer of Galvanize Climate Solutions writes, 2025 is not about climate. It's about energy demand. Renewables should be at the center of new energy build, no matter your political persuasion. Tom, I'm pleased to say, joins us now. You're excited about the year ahead because of that idea. I'm curious, have you talked to anyone in the incoming Trump administration or of that party's persuasion that convinces you that they see things similarly?
Well, I haven't talked to anybody directly in the administration. I've talked to a bunch of Republicans in Congress and Republicans who are advising the administration. I would say what I'm seeing is what's driving energy is markets, costs, international competitiveness, national security. And those are things, there's going to be a lot of political talk. There is a lot of political talk. The words drill, baby, drill are, renewed part of the American conversation. But what we're really seeing is the differential in costs. So if you look at renewables are cheaper now. If you're following where natural gas is, and we're talking a lot about the more demand for electricity in the United States and around the world. Renewables are cheaper. What we're seeing is they're continuing to get much cheaper at the same time that natural gas in the United States, I don't know how closely you guys follow it, was $3.86 an MCF this morning. That's almost double where it was. And in fact, in Europe, natural gas is $12.86 an MCF. So when we talk about exporting liquefied natural gas to Europe, it's because we want to sell something that we can sell at $3.86 for $12.86 across the pond. obviously that's going to push the cost of American natural gas up. So when we really look at international competitiveness for the United States of America in electricity, when we look at it in terms of cars, what we can see is the markets, business, economics are driving us to clean energy. That's where we're going. There's nothing political talk can do about it. That's what the costs say. That's international competitiveness. That's how we're going to win.
Okay, so the cost structure that you believe will make the argument for us. Which industries are going to make that case to the White House, the incoming White House? Because they're looking at the energy industry, the oil and production and gas companies, and they're saying, you know, we're going to move forward. We're going to go explore and look for oil in all these different places, the Arctic, wherever.
For all the industries, including AI, that are demanding electricity, they're going to want the cheapest electricity because that's a huge driver of how they compete internationally. And the cheapest electricity is going to be renewable. That's true here, and it's true around the world. So when we talk about the idea about moving back to fossil fuels, the implication is somehow fossil fuels are cheaper. They're not cheaper. They're already more expensive. In 2023, 86% of new electricity generation in the whole world was renewable. They weren't doing it to be nice. It's all about international competitiveness and national security. The sun is going to keep shining. The wind is going to keep blowing, regardless of what political people do. So this is something that's going to be driven by business decisions. And honestly, I think the Trump administration will get behind it because that's what's going to drive American competitiveness.
When I talk to Republicans, they say that they just want the market to decide, and they're above all in for all energy across the spectrum. Do you think deregulation that this incoming administration talks about will help renewables as well, as much as it's going to help the fossil fuel industry?
There's no doubt about it. There is no doubt
Why
that
don't you think Biden didn't lean into that, some of that deregulation?
Well, I think he did lean into it, but I think that this is a difficult problem because it's a political problem. And it includes people on the left who want to make sure that everything we do in terms of siting and permitting is done perfectly. I think that the Trump administration, because they really want to permit new oil and gas drilling, are going to be pushing for faster permits and, lower oversight. And I think that if that goes to including to renewables, what we're going to see is an explosion of low-cost, abundant, renewable energy. That's what we're going to see.
You say the U.S. is short energy next year. How?
How is that true?
Yeah, we're the biggest crude producer in the entire world. We have an abundance. We're a net exporter.
So let's talk about crude for a second. We produce 13.5 million barrels of oil every single day. We're the biggest producer of oil in the world. We're the biggest producer of oil in the history of the world. If we do everything that the Trump administration wants to do in terms of Alaska, opening up those lands, in more than 5 years from now, we'll go from 13.5 million barrels a day to 14. Give me a break. That's the big revolution, 13.5 to 14 in 5 years.
Incremental.
Yeah, it's hardly any change. And in the context of a world that uses 102 million barrels a day. So when you really look at what's going on in this world, we're going to have to produce a lot more electricity, and that's something which is going to come from renewables. If you look at oil demand, the developed world has already peaked its oil demand. China is going to be peaking its fossil fuel demand in 2027. That is not something where demand is going to be growing. Electricity demand is growing dramatically. Gasoline usage is either flat or going down.
3 Mile.
Yes.
Tech companies are now going after their own electricity. Do you think there's more for nuclear?
Look, the question in nuclear is simple. There's the question about toxicity, nuclear waste. There's the question about making sure you don't have a true disaster, which is what 3 Mile Island is normally associated with. And there's cost. And there are two kinds of nuclear, but we're talking now about fission, which is the kind of nuclear energy that we've been using for decades and that France uses so much of, and that we still use a lot of. The question with fission has been every time that people have tried to bring fission on in the United States, it hasn't been cheap. If you look at the last nuclear plant to be brought up, it was brought up in Georgia, and I honestly think it was something at least 4x the original cost. Very, very expensive energy. In fact, that's energy that is very expensive versus renewables that are very cheap. It's a little more, it's more complicated than that because you have to talk about baseload energy. But I'm just saying, if you look at nuclear energy, the promise has been there for a long time that it would be abundant and cheap, but they've never gotten it to be cheap.
So can these big tech companies get the energy they need from renewable energy? I mean, is there enough of that right now, or
There's no question there's enough. The question about electricity, and particularly electricity for AI, is it has to be available 24/7, 365 with absolute certainty.
No interruptions, no breaks.
And so the real issue here is how much base load energy, stuff that you can definitely call on at any time, do you need, and where's that going to come from? Can it come from batteries? Can it come from hydro? Can it come from nuclear? Can it come from fossil fuels? And can it come from enhanced geothermal? There are a lot of different questions. There are a lot of people with different answers. And, you know, everybody's trying and everybody wants to get baseload energy that's really cheap. And, you know, I have some opinions about that, but the proof of the pudding is going to be in the eating. Who can really produce it? How much can they produce? And can it be completely reliable?
All right, Tom Steyer is setting us up for a discussion that we'll be having for the years to come. Tom, appreciate your joining us today. Tom Steyer,
great time to be here.
With Galvanize Energy. All right, let's get you an update now on stories elsewhere this morning and check in with Danny Berger for your Bloomberg Brief. Danny.
Thanks, Scarlett. President Biden is commuting the death sentence of 37 federal prisoners to life in prison without parole. According to a roster of pending death sentences, Biden's actions would leave just 3 inmates on federal death row. They were convicted of terrorism and hate-motivated mass murder. The president has now spared the lives of more federal inmates than any president since Woodrow Wilson. Rupert Murdoch's News Corp has agreed to sell Foxtel Group to sports platform DAZN Group, the deal that values the Australian paid television and streaming service at $2.1 billion. DAZN, backed by billionaire Len Blavatnik, is a prominent player in the broadcast of live sports. And speaking of live sports, a thrilling upset in Washington after the Commanders stormed back for the last-minute touchdown against the Eagles. Rookie QB Jaden Daniels made up for a late-game interception with a clutch final drive to seal the win. That improved the Commanders' record to 10-5 and ended the Phillies' 10-game win streak. Elsewhere, the Vikings improved to 13-2 after beating Seattle by 3 on the road. That's your brief. Scarlett.
All right. And of course, more exciting football games to come later on this week. Up next, record-breaking holiday travel. We're seeing an uptick in lodging, travel, experiences, which is also what we see in our consumer data. There's still strength there and still some dry powder. What you need to know before you get on the plane for your holiday travels. That's next. You're watching Bloomberg Surveillance. Under surveillance this morning, record-breaking holiday travel. We're seeing an uptick in lodging, travel, experiences, which is also what we see in our consumer data. So people are spending on, memories. How do they take trips? We continue to see strength in the consumer in all cohorts. And, they are spending, and we've seen an uptick in holiday spending going into the holiday season. And so, there's still strength there and still some dry powder. Here's what's happening now. Nearly 40 million people expected to pass through airports across the country this holiday season, up over 6% compared to last year. That's according to the TSA. Joining us now is Clint Henderson of The Points Guy. Clint, it is good to speak with you. Anne-Marie and I are in the office because it is a Monday and we still have 2 days to go before Christmas. Talk a little bit about the calendar effect, because with the holidays on Wednesday this year, it means there isn't a natural long weekend for people to take, and maybe that spreads the travel out a little bit here.
Yeah, that's certainly helping. Interestingly, though, the Sunday after Thanksgiving, we saw the highest single day ever. So that didn't really impact Thanksgiving travel, and we were expecting record-breaking crowds. I will say the airlines got through the busiest part of the lead up to Christmas fairly well, despite a few storms. So that's good news. And I do think the airlines in general are in better position. They're staffed up. They have the planes they need. They have the people they need to get things moving quickly. And they seem to be able to recover from storms better right now, too. So barring a major storm like we saw in 2022, fingers crossed we'll get through the holidays with flying colors.
Yeah, so far, no major storm at the moment, and also good news, no shutdown either. So everyone can get through airport security the way that you would expect them to during a busy holiday season. People are obviously traveling to visit family or go home, but they're also going away on vacation. Where are they going to, Clint?
So it's really interesting. We've seen the usual suspects are obviously very popular. Los Angeles, New York has been going through some incredible record-breaking crowds. The big cities in the U.S. and also places like Florida and Cancun. But we're now seeing really interesting data that suggests Americans are going much further. They seem to be being inspired by TikTok and Instagram to really get out there and have a little bit more exotic travel. Tokyo is actually one of the top cities, according to Chase, this year for international travel, which is really interesting. The strong U.S. dollar is certainly helping. I think that's going to really push up numbers in Europe as well, since the euro has been falling lately. So look for some international bargains. I just booked myself a trip in January to Portugal. Incredible what you can get because the US dollar is so strong right now. So, and then don't sleep on shoulder season travel. A lot of people are traveling now well into winter. And then, of course, for the shoulder season, which we love, which is spring and fall. And people are spending longer away. That's a new survey we just did. Found people are spending 5.5 days as opposed to 4.5 days like they used to. So people are going further and they're going for longer.
Why are they spending longer? Is that they feel that, is it the strong U.S. dollar? They feel like their money can stretch them that much longer on a trip?
I do think that's part of it. I also think people are really into experiences now, as your soundbite alluded to. And I think the other interesting thing is people can work from home now. So they're tacking on a day or two to business trips that they might not have in the past because they have to be in the office. So, you know, you're in the office today, but I'm able to work from home. And I think more and more people have been able to do that. So you're seeing the amount of time they're spending away stretched a bit.
Clint, any viewers that are preparing to travel this week, what's your number one tip?
Have the airline app installed on your phone. Not only is that how you're going to get Wi-Fi, entertainment on the plane, you can track your flight, see if it's on time, see where your plane is coming from. And finally, that's where they're going to offer you cheap upgrades. So you beat out elite travelers like me so you can get a cheap upgrade to first class. So who doesn't want that as a Christmas gift?
I love that. What about luggage? That's a big issue here. And I know that this might sound kind of trivial, but you know, we're all trying to get by bringing it on as a carry-on. And yet when you get to the airport and you're at the gate, they make you check it in anyway at the gate. They say, oh, we'll waive the fees. But that's, you know, everyone's trying to avoid that scenario. Any advice on that front?
Yeah, you know, I'm team carry-on, so I hate checking baggage. But during Christmas, when I come from New York to California, I bring presents with me, so I do check bags. And you know what I got? An Apple AirTag for the first time in my life. You know, we've been writing about this and talking about it for years. My team loves it, but it's the first time I've used it, and that is really cool. And now with the AirTags, some airlines allow you to share the location with the airline, so if your luggage gets lost. So maybe I have to look more into checking luggage in the future and try not to be the last to board, pay for that extra seat, get the airline credit card so you can be among the first to board that plane.
Talking your book. Clint Henderson of The Points Guy, thank you so much for joining us. Really appreciate it. Coming up, we've got Dana Dioria of Envestnet, Jonathan Miller of Miller Samuel, and Nela Richardson of ADP, as well as Vishal Khanduja of Morgan Stanley Investment Management, a veritable lineup of experts to take you through the next hour. You're watching Bloomberg Surveillance.
Data on inflation have been coming in a little slower. I wouldn't even say sticky or stalled. I would say the progress has just slowed.
The Fed has to reiterate its commitment to its inflation target.
I think the market at every step has been worried about inflation and has been rejecting these moves by having yields go up.
It's really about the bond market. So effectively, where people are starting to get nervous is from a positioning standpoint.
Big question to me would be how high can these yields actually go?
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning on this Christmas Eve from New York City for our audience worldwide. This is Bloomberg Surveillance alongside Scarlett Fu. I'm Anne-Marie Hordern. Scarlett, thank you for keeping me company this morning. You're not used to, again, I feel like the 3 a.m. wake-up call, so thank you so much.
I woke up at 2 a.m. because I had to make sure that I was fully awake and ready to go.
Well, we appreciate it, especially as we are on the shortened holiday week. Torsten Slok just published something. Thank you, Torsten, for working as we are as well. You're one that's continuing coming into the office and not taking an early cheeky holiday. Tariffs coming. He points out the risk to global markets in 2025. Tariffs coming at 90%. That's number one. Number two, NVIDIA earnings disappoint inflated expectation, 90%. And the U.S. economy reaccelerates and animal spirits come back. 85% chance.
Yeah, it makes for a pretty volatile 2025, doesn't it? The U.S. economy will continue to grow, and that's perhaps the issue because inflation is going to be the bugaboo. And he goes on to say that, and he's been kind of out front in saying this, that he thinks that there's a chance that the Federal Reserve actually raises interest rates in 2025. We know that last week they revised their projections to only cut rates 2 times instead of 3 times. Now Torsten Slok is talking about tightening policy.
Right, that's right. Number 7 on his list. Fed raises interest rates in 2025, 40% chance. Adam Posen has been talking about this at the Peterson Institute for a while as well. How much of this is because of fresh policies coming in from the Trump administration? It goes back to his first point. The tariffs are coming. Are they going to be inflationary?
Tariffs are coming. We don't know in what form. We don't know exactly how much. We don't even know which country they will be imposed upon because every day it seems to grow, right? Panama is being kind of the latest one to get caught up in the mix. Mexico, Canada, China, of course, the EU for not buying enough U.S. oil and gas. It just continues.
Possibility. Okay, coming up this morning, Dana Dioria of Envestnet, as stocks look to start the shortened trading week higher. Jonathan Miller of Miller Samuel on the housing state of the housing market heading into the new year, and Nela Richardson of ADP on wage trends to watch in 2025. We begin this hour with stocks higher. Investors waiting to see if markets can clinch a Santa Claus rally to end the year on a high note after paring back major Fed-induced losses. Dana Dioria of Envestnet saying the Fed delivers the cut with a but. January is more than likely off the table for another cut and going into 2025. The base case should not be more than another 50 basis points. With the potential for inflationary policies next year, why potentially ruin everything just to squeeze another couple of rate cuts into the cycle? Dana joins us now. So Dana, you basically are recalibrating after the Fed recalibrated. Is that fair to put it?
Well, I think it's definitely a recalibration, although I'll say that I think the market has overshot all year. So I wouldn't say I was recalibrating as much as the market has been. I mean, we've gone through a year of market just kind of overshooting on its expectation of Fed cuts. And that was happening in spite of, market being great, unemployment being great, no reason to think that even, GDP was in danger. So it's not surprising that, of course, we kind of came into the end of this year with higher expectations for next year than what the Fed has in mind. And it's not surprising at all either that, the Fed is going to give itself some room to breathe. I mean, we're getting towards the end of this rate cutting cycle. Doing it every single meeting probably didn't make a whole lot of sense anyway. And of course, as you were talking about just earlier, there's a lot of uncertainty as we go into 2025, right? Around what's going to happen on the fiscal side, tariffs, what's going to happen with inflation. And if there's anything that the Fed could do that this Fed would consider a fail, it would be to let inflation take hold again. So it really shouldn't surprise anybody that we're probably going to skip January. And when I say base case going in at 50, look, that's kind of almost meaningless, right? I mean, that's your base case today, knowing what you know now. But really what has to happen is we have to see all of the data that's going to come in 2025 and determine what we're going to see through the course of the year.
It's a good point. And it's fair that you say this. Remember, it was this time last year, it was going into 2024 that the market was expecting at some point 6-8 rate cuts. We ended up getting just 3. Torsten Slok, as Scarlett Fu and I were just discussing, talked about the fact that Fed raises interest rates in 2025 maybe at a 40% probability. This is one of the risks he writes down. Do you think we could see hikes in 2025?
You can't pull it off the table. I mean, again, that's not a base case from my perspective, but you certainly can't pull that off the table. because of the fact that the Fed will fight hard to keep inflation down. So now look, we had a decent reading on Friday, right? I mean, we don't necessarily have reason to think that inflation is rearing again at the moment. It's not coming down as abruptly as it was. The Fed wants to, of course, they want a two handle, right? Like there is to a certain extent some, ambiguity as we go into 2025 about what inflation actually is going to do. So I would say a rate hike is not the base case. But if you saw inflation coming back, I don't think the Fed could afford to hesitate to try to tamp it down, especially if it's coming back because, they're combating what's going on the fiscal side. They're combating inflation that's being created by tariffs, by decisions around immigration, things that are just out of their control. They've got the one hammer. They're going to have to use it.
Yeah, well, that mix of concerns is what is keeping yields, especially on the long end, elevated. And there's increasing talk about a 5% 10-year yield, maybe even 6% if you believe T. Rowe Price. Not to hammer on what Torsten Slok has been predicting, but he does talk about the odds of a 10-year yield above 5% before mid-year at 40%. If that were to happen, and he's not the only one predicting this, what does that mean for different parts of the stock market, whether it's the S&P 500, the NASDAQ, and the Mag 7, or small caps?
Yeah, so, we know that higher for longer and higher rates in general are not good for areas of the market like small caps, right, that are interest rate sensitive. And, there's an assumption there, too, about what happens with the rest of the curve, depending on tenure. Obviously, very bad for real estate. Small caps much more interest rate sensitive because they're dependent on going back to capital markets for money. And so if we have this situation where rates are higher, and then of course stocks in general, right? When you're talking about a 10-year that's hitting 5 and north of 5, this is going to impact everybody to a certain extent. I think Mag 7, these big tech companies that really aren't dependent on capital markets, they're very much cash funded. Those remain the defensive, quote unquote, plays in a case like that, right? Because you can hide out there and they're not going to have that impact. But as a general rule, the systematic market overall risk is going to rear its head if you're seeing 10 years north of 5.
Yeah, and we look to the Mag 7. They've certainly seen a resurgence over the past couple of days, and this idea that you have a broad market rally being a more durable rally than one that is on narrow breadth, and that's certainly what we've been getting more and more. How do you think through leadership rotation with positioning for what people expect a president like Trump to do when it comes to the tech sector, the healthcare sector, or anything else?
It's interesting, right? Because, there was such a very clear codified Trump trade as we went into the election. And look, if you traded around that and Trump, obviously Trump won, you made money on that, right? Because, the short-term impact was quick, priced into the market like, Trump winning, this is great for financials, the pharmaceuticals, right? And then he has a pick RFK that now all of a sudden is, this isn't so good for big pharma. You were just talking about earlier how it's very hard to tell where in the market, Trump is going to potentially want to levy some tariffs. And so again, going into the election where everybody kind of thought they knew what he was going to do, you could trade on this. But coming out of the election, number one, you have to predict where he's going to go, things he's going to do that may offset your earlier predictions. But you also have to, in a market now where it's known that Trump is the president, you have to sort of outsmart the market's collective price around what those things are going to do. So it's not only figuring out where he's going to go and what he's going to kind of do, but it's also then saying, do I know more about what I think Trump is going to do than the rest of the market? Because the rest of the market is already pricing that in. So I think trying to rotate based on, some assumption and forecast around what Trump is going to do is very, very difficult now. The big win was just that sort of binary, did he win the election or not win the election?
Terry Haines joins us in the last hour, and he said Trump burned up some market credibility last week when it came to the whole shutdown drama. We entered this week not having a shutdown, but it definitely took a lot of work in terms of Speaker Mike Johnson having to really corral his party to get this over the finish line. Do you agree with Terry Haines? Do you potentially think Trump, burned up some of this market credibility in this short instance? Well,
the shutdown didn't happen, right? And I think memories are short. I I wouldn't say the shutdown per se, because it didn't happen. And I think, the overall outlook's going to be, hey, they pulled it out, right? And how much Trump had to do with that or didn't have to do with that is, kind of can be a behind the scenes. I will say, though, that what I think, and this is pursuant to what we were just talking about, it's hard to predict what Trump is going to do. And so I think from the perspective of a market that doesn't like uncertainty, doesn't like to have to price in maybes, or I think it's going to be great for Bitcoin. And then, something happens where, the Fed decides, hey, we're not actually going to lower rates as fast as we thought because Trump's policies are inflationary. I mean, I think the credibility less than just trying to predict what's going to happen here, I think the market has, a little bit of unease around that. And that is going to be the case.
Do you think Bitcoin is going to be the asset that really follows Trump policies? You write in your note, Bitcoin haters feel the pain.
Yeah, I mean, certainly, what we've seen, and notwithstanding last week, but what we've been seeing, of course, since the election, and Trump really, drummed up his interest in crypto. He was going to be, kind of the best president for crypto. So I think that is one way to look at it. But crypto is a really risk-on asset, very volatile. And again, could be just the vagaries of the market in general can drive crypto. And that might not even be specific to Trump's policies. So I don't know that I think there's one asset that you can really track and follow based on, Trump. But I do think Bitcoin as a very risk-on asset sort of tells you what the general zeitgeist is at the moment.
Dana Dioria, thank you so much for joining us this morning on your holiday week. Dana Dioria of Envestnet, we thank you. Let's get you an update on stories elsewhere making news this morning. Here's your Bloomberg Brief with Danny Berger in London. Hey, Danny.
Hey, Anne-Marie. Prime Minister Benjamin Netanyahu said Israel will act forcefully against the Houthis. Over the weekend, a missile fired from Yemen struck Tel Aviv. Netanyahu called on Israeli citizens to be patient, saying that it may, quote, take time. Apple is considering challenging Amazon's Ring. The company is working on a smart doorbell that will have advanced facial recognition that wirelessly connects to a deadbolt lock. The idea being that the doorbell could automatically unlock the home for a resident by scanning their face, just like Face ID that lets them into their iPhone. And in sports, a thrilling upset in Washington after the Commanders stormed back for the last-minute touchdown against the Eagles. Rookie QB Jaden Daniels made up for a late-game interception with a clutch final drive to seal the win, improving the Commanders' record to 10-5 and ending the Phillies' 10-game win streak. Elsewhere, the Vikings improved to 13-2 after beating Seattle by 3 on the road. That's your brief, Anne-Marie.
Thanks so much, Danny. Up next, the morning calls, plus Jonathan Miller of Miller Samuel on the state of the real estate market in 2025. That's coming up next. You're watching Bloomberg Surveillance.
Let's take a look at how markets are faring right now. With about an hour and 15 minutes to go before trade begins in the cash market, you have futures mixed at the moment. S&P 500, little change, modest gains there. Euro dollar, that's been a consistent weakness for euro. Anything that's trading against the dollar for that matter.
I go back to what the points guy said. How much strength do Americans feel like they have right now using this dollar around the world? Seriously. They're looking for deals elsewhere, whether that's in Europe or whether it's in Japan.
Go to Europe, go to Japan. Treasuries, we're seeing a little bit of declines there in yields. And of course, that's been on the back of, declines in price, move higher in yield. The red arrow always confuses. The red up arrow, I know, it gets me each time. Nevertheless, the theme here for Treasury yields is that they have been rising, and that has not stopped. New York crude down 0.5%. Still plenty of supply around the world, Anne-Marie.
And a lot of spare capacity, as to what Amrita Sen had to say. So even if there's not a ton of that glut right there, the fact of the matter is there's 2 countries sitting in the Gulf that could turn on the taps almost immediately.
Good point. All right, let's stay with yields and rates and turn now to real estate, because a challenging market is expected to continue in 2025 thanks to higher mortgage rates as well as limited supply. Jonathan Miller of Miller Samuel is staying optimistic. He says, while we don't expect sales to rise to normal levels, they will be higher than last year. Those who can afford to buy at higher rates will probably do so. Mortgage rates will probably end up lower than they start the year, but not low. Jonathan joins us now. So, Jonathan, you have actually noticed an uptick in existing home sales, in particular in high-end markets in places like New York.
Yes, that's actually been the story. If you think about it, many potential home buyers have been waiting for about 3 years since the initial Fed moves. And I think time is sort of running out for people as life moves on. We're already seeing in contract activity in some of the markets that we cover really begin rising back in the summer, not just after the election. But of course, on the national front, existing home sales for the last couple of months have been up, which means that, with all the sort of people holding, waiting for lower rates, I still think there's a thinking that, perhaps a year from now, rates will still be a little bit lower, and those that can afford to buy are buying. The challenge is supply. Supply continues to be a problem. It's less of a problem in the Sun Belt states where there's been a lot more development activity, but still, a year from now, I think housing prices are going to be higher than they are today, and so you have to sort of, make the decision of, do you wait for rates to come down at some point? If they will, it doesn't feel like it with the incoming administration's economic policies.
So you mentioned the Sun Belt and this idea that it is rising, the inventory that's available. People point to that and say that they want to move to somewhere where perhaps housing is more affordable. But it's misleading, though, when you look at supply increases as well, because we're coming off a pretty low base. How often is it that people go over and realize actually the picture here is very different from what they had anticipated? And if you compare it to, say, 5-10 years ago, it's completely different.
Yeah, I think post-pandemic, there's still an expectation by consumers when they go from, say, the Northeast or California to the Sun Belt that they're going to get a very low price, and the affordability is going to be dramatically improved. However, that's been where a lot of the price appreciation has been concentrated. As people with work from home are looking at other places to be situated. One of the things that we're seeing in, for example, markets like Florida, especially South Florida, is that the higher end threshold, meaning pricing north of, say, $1 million, not to be cavalier about the numbers, we're seeing a tremendous uptick in activity. Perhaps that has more to do with elevated financial markets than it does to the factor of higher mortgage rates.
Jonathan, given the fact that there are higher mortgage rates, are there deals to be had on the price when going out and buying a home?
I think the simple answer to that is no. But that's because even in markets where inventory is rising or there's parity with pre-pandemic conditions, the demand is still pretty strong, that people have been kept on hold for several years. So we're still seeing bidding wars. We're still seeing a fairly tight market. We're just not seeing a lot of discounting going on, and I think that's what consumers, were hoping for.
You expect an uptick in 2025. Where exactly do you think we can see an uptick in some of this?
Well, the basic math is where the inventory is the tightest, that's where you're going to see the most uptick in price. I would say that the biggest uptick in price is not going to be in the Sun Belt. It's going to be to the north of that, because that's where not as much new product has been built to come into the market. That's one of the challenges in markets in the Sun Belt, is that there's been more new construction as developers are anticipating the boom coming off the pandemic, and it's been a little bit overdone.
Jonathan, we talked about single-family homes. What about multifamily homes? With the idea that mortgage rates will be lower at the end of the year than where they start, but not low by anyone's measure of what tends to count as low, how does that affect the decision to rent versus buy? And what does that mean for those who do own or are looking to buy multifamily properties?
Well, one of the problems that we've had in the multifamily, particularly in the condo market, is that housing prices, have risen just like single family quite a bit, and affordability is being challenged. The problem is in the multifamily, there's more supply or excess supply, which means potential softening or more potential softening. So from a single family perspective, I think it's a little tougher to get a deal. In the condo, maybe a little bit more, but not in the high end market. We're talking about more normal priced property. I think we'll see less price growth because supply is not as excessive as many consumers were thinking.
Okay, and moving away from residential property into commercial property, there's been a lot of discussion about an incoming Trump administration being good news for real estate overall, but in particular commercial real estate, especially with transactions picking up pace, or at least conversations about transactions picking up pace. Are there numbers that bear this out?
So the way to think about commercial, and the part that I still am amazed, because the narrative about commercial is, hey, it's coming back. It's, work from home maybe is going away, because we're seeing, various firms talking, ending work from home or severely reducing it. But really, the conversation is almost entirely about Class A. If you think of commercial office as Class A, B, and C, A is doing just fine with relatively high occupancy and relatively stable and elevated leasing prices. It's a best in all the rest scenario. Class B and C are still being punished by the work from home phenomenon. And, many of my colleagues, including myself, believe that work from home is here, structurally for indefinitely, and that's where the opportunities are. In fact, we're seeing a little bit more on the B and C. We're seeing more residential, office to residential conversion activity, which is difficult in high interest rate environments, but we're still seeing it beginning to occur. So I think that's where the upside is. In the Class B and C, it's not going to be sort of leasing up at normalized prices.
Yeah.
One other point about that is a lot of the B and C, the problem with high vacancy in those markets is that the landlord can't reduce their prices to market level.
Yes.
And that is a condition that has stayed since the pandemic era,
right.
And I don't anticipate that changing in the near term.
All right, Jonathan Miller of Miller Samuel, thank you very much, and happy holidays to you.
My pleasure.
Sir. Coming up next on Bloomberg Surveillance, we've got Nela Richardson of ADP and Vishal Khanduja of Morgan Stanley giving us their take on the labor market and the financial markets, especially the move up in rates. This is Surveillance.
We're just about an hour from the start of Cash Open this morning. It is the final week of 2024, and this is what we are seeing across the trading markets. Obviously, volumes are going to be light. Most people are either at the airport, already home for the holidays. S&P 500 futures are flat. Last week, they closed down on the week. NASDAQ futures, though, up 0.4%. We are closing out the year, though, with the S&P 500, Scarlett, up more than some 20% this year.
And it's remarkable because if you look at the different indexes and how they've done, the NASDAQ has led the way, and we're going to end the year with the NASDAQ leading the way as well. So that rotation into small caps, it had its moment. I'm not sure if it's over, but for now, people are going back to the safety of big tech.
Right, and potentially could it come back maybe once they see the actuality of Trump's policies, not just what they're trying to, wishful thinking into Trump 2.0 in 2025. Across assets, what we are seeing as well in the bond space, Scarlett's been talking about it, just this theme of rates will be going up. They will be going higher. Right now, the 10-year yield, 4.5%. 8%. We do have an auction today. I sound like Lisa Abramowitz now at 1 p.m., a 2-year bond auction. But you brought up T. Rowe Price earlier. They're talking about potentially 5% on the 10-year yield. How much more difficult will that make policymakers' jobs in Washington, D.C.?
Yeah, it'll be complicated. It'll also raise the cost of servicing our debt tremendously, which is
already
we can ill afford.
And it's already a huge part of the budget.
Yeah, absolutely. And it's something that all the government officials will be taking a closer look at, especially since we have an incoming Treasury Secretary who's fixated on our debt levels. Yeah, T. Rowe Price talking about not just 5%, but even 6% potentially. I mean, it's an outlier, but it's out there.
At some points, 5%, 6%, that is going to take a huge bite out of the stock market. And then, of course, in currencies this morning, strength of the U.S. dollar. That has been a theme of late, a theme for 2024, this idea of U.S. exceptionalism. But look at this. Euro dollar, 1.0394, sub 104. As many analysts, Jeff, you talking about parity going into next year. The points guy earlier today, as everyone is traveling, saying foreign travel is more attainable now, and it's more exciting to Americans around holiday time. They're going to Japan. That's one of the top 5 destinations on the Christmas list. How much of that is because of the strength of the USD?
I'm sure it's part of it. If you want to go skiing, let's just say in Utah or Tahoe, it's going to set you back, what, $150, $200 for a day pass to go skiing if you don't have Epic Pass or one of those programs. If you go to Japan, yeah, you have to pay for the airfare, but once you get there, things are more affordable than they are here.
That's on my bucket list, actually, skiing in Japan. Can't wait to do it one day. All right, under surveillance this morning, the Biden administration launching an investigation into Chinese-made semiconductor chips. The inquiry focusing on foundational chips, common across a wide range of industries. The move teeing up potential tariffs on the sector from the incoming Trump administration. So passing of the baton when it comes to China. And basically what this would mean is that the Trump administration would need to pick this up. But this is one area where you see both parties really agree on, and that's talking tough on China.
Absolutely. And, if the incoming administration were to take up the action, this would be a Section 301 investigation, the same action that Donald Trump used in his first term of office to impose tariffs on China. The U.S.'s take here is that China has expressed this ambition to dominate the global chip market, and it unfairly subsidizes that industry. So the U.S. needs to take action immediately. The fear is that China will flood the market with really cheap chips and make it so that it's uneconomical for anyone else.
And the head of 301 is going from Catherine Tai to Jameson Greer. This is someone who's basically a mini Lighthizer, as maybe you'd want to call it. And when he gave a testimony to Congress this year, he talked about decoupling from China. So you can obviously expect, I think, the incoming Trump administration potentially take up this provision. Also under surveillance this morning, in corporate news, Honda and Nissan taking their first steps towards a merger. Really, all of this is about China as well, signing a basic agreement for talks. A holding company will be created to house the new entity and should be listed by 2026. The merger would create one of the world's biggest car makers competing with Toyota, and there it is, Chinese automakers. How much more consolidation potentially are we going to see in this space because of that, because of China, and how cheap and efficiently China can pump out an EV? You can get a Chinese electric vehicle for $10,000, $12,000.
Yeah, and there's a reason why we haven't seen it in the U.S., because it would put U.S. automakers out of business if that were to come in. Not that that's even a possibility right now, given the tariffs that people have talked about. But yeah, this is a big issue because Nissan has lost a lot of market share in China. A stronger Honda with Nissan may blunt some of that market loss. And at home, they need to compete more efficiently against Toyota.
That's right. Also this morning, Apple considering challenging Amazon's Ring. The company is working on a smart doorbell that could automatically unlock the door by a home's residents by scanning their face. Just like Face ID lets them into their iPhone. What do you think of this? More tech.
More tech, but on Apple's terms. So Apple has this play that it always goes to consumers, which is that we take privacy, your privacy, more seriously than the other big tech companies. And I think this plays on that idea that you can be secure in knowing that whatever video is recorded on, in front of your door will be safe on our cloud versus the other big tech companies.
A lot of apartment buildings actually are retrofitting so that you just have to show your fingerprint, kind of like the Bloomberg terminal. And they just have to show your fingerprint and you can get into your home. But I guess this would be easier, showing your face.
Showing your face might be a little bit easier. I mean, this is also part of Apple's ambitions to own the smart home space, or at least get into it. It's been a little bit behind. It's playing catch up. Certainly, Amazon has done a better job. Google has done a better job as well.
Okay, turning to the U.S. economy, new home sales and Conference Board consumer confidence data due later this morning, with this year's last round of weekly jobless claims ahead on Thursday. Joining us now to preview is Nela Richardson of ADP. Nela, you have a piece out talking about what you're looking out for the labor market next year. What's your top concern?
Pay growth. And it has to be Goldilocks, Anne-Marie. If we're looking at the one thing in the labor market that we want to be confident in is that wages are going to grow high enough that consumers can keep spending resiliently like we've seen, but not too high that we trigger inflation. So we've actually seen pay growth level out at higher levels. And in ADP's own data, we saw pay growth for job stayers increase for the first time in 25 months. If this continues in 2025, it makes the job of the Federal Reserve in tapping down inflation that much harder.
So do you think the Fed was actually right in some of the language that they came out with last week?
I think they are right to be cautious and to be wary of inflation ticking back up. Now, they've got some good news with the PCE on Friday. The month-over-month looked promising. Hopefully, that continues into 2025. What I'm saying is that wage growth is that bridge between the labor market and inflation. And if wages continue to be at higher levels, it doesn't mean that they can't get back to 2%. It does make it hard to stick at 2% for an extended amount of time. I think markets are overly concerned about hitting 2% that one time. I think we really need to focus on the long-term trajectory of inflation and what role wages play a part in that.
When we talk about wage growth, are we talking about high-end salaries or salaries at the lower end, hourly workers, for instance?
They're two totally different things. And it's great that you highlight that because we've been looking into both really high-end salaries and hourly workers. I'll start with hourly because they're 60% of the labor market. And what we've seen is that hourly workers are working less. So yes, hourly salaries are growing, but hourly workers' annual pay, when we talk about the entire 12 months, they're actually seeing less pay growth, not more. And on average, that's 2.8% pay growth for hourly workers over a course of the year. You match that with inflation, you get an hourly worker that's barely treading water. And that is not good news going into 2025 for lower paying jobs. And so this economy is being supported by a lot of high net and wealth individuals who've seen house prices go up, stock prices go up, and wages. So on the other side of that, less than 1% of workers are making $500,000 or more. But still, that's over 1 million workers who have these exorbitant salaries. And they're in every metro area. They're in every industry. You're seeing really high-paying jobs.
That's fascinating, and it really goes to show how when we look at wage numbers in the aggregate, it masks so much that's underneath the surface. We were talking with Jonathan Miller of Miller Samuel earlier about the outlook for commercial real estate and how so much of the office building outlook depends on work from home versus remote work versus return to office, and how many days people do go in, and therefore how much companies commit to the commercial real estate. There seems to be an accepted compromise that if you're going to work from home or have remote work, you will take lower pay. What do we know about the lower pay? How worth it is it to those who seek to stay at home? I mean, what is the number that turns it for them?
You know, we've seen housing affordability be a big part of labor markets.
Yeah.
And so this remote work, as it became more prevalent, it was an opportunity for workers to move to low-cost areas. And so what we did at ADP is we dived into the data when we looked at the same employers, the same teams, to see what remote workers were making relative to their teammates. And we found that they're actually losing about 3% less on year than the rest of their teams. But they're actually benefiting because they have such lower cost of living that on net they're doing better. So it's almost like a cost sharing between the employer and the worker. When employers, and we looked at this too, go to those same areas, those same low-cost areas, they still pay less than the workers that move there a year ago. So there is some sense of cost sharing between the employer and the worker, and that's because of high housing costs. So high housing costs, the takeaway here is it invades the labor market and it causes us to do different things with our time and our location than we otherwise would.
So remote workers find the lower pay worth it?
Yes.
And you
right
think
now they are.
And this trend, do you think will continue?
I think there's incentives, but your guest just said that he expects high housing prices to remain with us and actually climb higher. And so what's unique about where we are now, high house prices used to just be a coastal phenomena. Now there's really no strong labor market that you can turn to and not see high house prices. So where are those low-cost areas going to be? Are we going further and further remote to get that cost of living decrease? That's the question.
Do you think work from home as a phenomenon is going to continue? Do people feel the need to go back into the office, especially if they want to rise the ranks of a company? How do you do that remotely?
How do you do that when you're Gen Z? How do you learn how to work without actually stepping into an office? Now, most jobs you can't do remotely. So this is a...
Yeah, Scarlett and I can't work from home.
Maybe you tried it at one point.
It was
right?
terrible. Never doing it again.
Yeah.
Out of necessity, and then we moved on.
Yeah.
Yeah. Yeah, I actually like coming into the studio too. There's benefits from being together. Now, do you have to work every day in the office? Well, you guys do. I don't. And so there is a sense that hybrid work is a good compromise for some jobs, but not every job. Teachers, nurses, doctors. There's plenty of jobs you can't do that. But the big question is, will compensation change, evolve, because some people have this remote option and some people don't? Well, you get paid more in 2025 for coming into the office every day. That's the question.
What is the biggest risk in your mind to wages in 2025?
I think hiring. It's always going to be the risk. We're seeing a slowdown, a stabilization in the jobs market. And this is a market like every other market that is influenced by uncertainty. So if you're not sure about the outlook, if you're not sure what the Fed is going to do or what tariff policy is going to mean for your business, then you might change your hiring plans. You might kind of adopt this wait and see mode. And that will also influence the compensation that you have for new workers and for promoting your existing staff as well.
Nela, thanks so much for joining us, especially on this holiday week. Merry Christmas, Happy Holidays to you and your family.
Thank you.
Coming into the office for it, Nela Richardson of ADP and a Bloomberg contributor. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, Anne-Marie. CBS is reporting that former Congressman Matt Gaetz paid numerous women for sex and bought and used illegal drugs, citing a final congressional investigation report draft. Gaetz reportedly purchased and used drugs from his Capitol Hill office. He's denied having sex with a minor and using drugs in his written response to the committee. Amtrak passengers traveling ahead of the holidays are dealing with delays and cancellations in the Northeast. Amtrak says it's facing signal power issues, and travelers should brace for a significant delay in and out of New York's Penn Station. At least 8 services has been canceled, and 2 others between Boston and Washington were suspended because of equipment issues. And shares of Nordstrom, those are trading lower by 1.5% in the pre-market. The company announced it has signed a definitive agreement to be acquired by members of the Nordstrom family of Puerto de Liverpool, a Mexican real estate operation. The deal is expected to close in the first half of 2025, but is subject to regulatory and other concerns. And that's your brief, Anne-Marie.
Thanks so much, Danny, and have a lovely Christmas to you. Up next, setting up for your day ahead, plus Morgan Stanley's Vishal Khanduja. You're watching Bloomberg Surveillance.
All right, let's take a look at where things stand right now. Treasury yields are moving higher, and certainly at the long end of the curve. And a lot of that is tied to the Federal Reserve, indicating that it is not going to cut rates as much as previously planned. Only 2 cuts for next year rather than 3. Euro under pressure. That's been the case for a while now. Euro dollar at 103.97, so just below that 104 mark. S&P futures have been flopping around a little bit here, currently lower by 0.2% after declining week last week. In fact, 2 straight weeks of losses. In Anne-Marie, oil prices remain under pressure as well.
Yep, under pressure. But you mentioned it earlier, Amrita said, it's been this narrow trading range when it comes to oil prices. And that has to do with supply and demand fundamentals. What was so interesting in what she said is not about the glut of next year, but there is a ton of spare capacity out there. So if they had to, the taps could go on. And China is just not having the demand that they normally do.
Yeah, even with all the fiscal stimulus that they've telegraphed, that they've announced, it hasn't actually materialized just yet. Let's turn back to the U.S. economy because San Francisco Fed President Mary Daly says she's, quote, very comfortable with the Fed's median projection of 2 rate cuts in 2025. Vishal Khanduja of Morgan Stanley is writing, data and policy dependence will remain the theme for the Fed in 2025. Tension was building between the persistence of inflation in the forecast versus a policy rate outlook that calls for far fewer cuts than before. Vishal joins us now. Good to speak with you, Vishal. Thanks for speaking with us today. And of course, one of the big issues here is that the Fed favors both forward guidance as well as data dependence that you referenced, which to some extent are kind of at odds with one another. There's a natural tension there. At this juncture of the Fed's rate cut campaign, which is more important, data dependence or forward guidance?
I think data dependence is definitely more important for us all the time, and even now continues to be the case. I think the market is getting slightly ahead of itself on the other side this time. I think right after they cut the 50 basis points in the first meeting, I think the last 3 meetings, they've cut 100 basis points total from 550 to 4 3/8 to 450 at the moment, that the market was overpricing about 250 basis points of cuts till end of 2025 after the first cut. And now the market is underpricing almost to the point of that the Fed is done here, which from our perspective, absolutely not. And that's why we've started to find that 0 to 5 year part of the curve very attractive on that part. And then one last point on that question, Scarlett, would be that not only data dependent, but very policy dependent as well. I mean, like not only the Fed, but then other central banks have held off some of their actions this month because they want to have a little bit more clarity on the first 60 to 90 days of the new administration. I think we heard it very clearly from the BOJ. They want to watch their inflation wages and how they're coming through, and then also look at the first stab of policies here from the U.S.
Right. It wasn't just the BOJ. The BOE basically did the same as well. So that raises a question, and it's something that was brought up at the Fed press conference and maybe is still a concern given how we're seeing Treasury yields continue to move up, which is why cut in December if there is still such a cautious outlook for next year for further rate cuts. It turns out the last cut was a pretty close call, and people question whether it was necessary at all, given the economy grew 3.1%.
Yeah, no, very, very, very fair questions. And I think the same sort of market participants were questioning the question at 3 meetings back was almost about whether the Fed is behind the curve. So we do think that, yes, around this 450, 425, 450 level is a fantastic hangout spot right now for the Fed. Yes, we can go back and forth whether this last cut, 25 basis points, was warranted or not, given the data. I think the labor market is still not completely out of the woods, according to us. I think you're still seeing that sub-100 private payrolls on an average going through, which is very different than the middle part of the year. So there is some part of that sort of monetary policy or slightly not as loose fiscal policy during certain parts of 2024 that led to the labor market weakening, if you will. Again, now weakening coming from a very, very strong trend. So let me be very clear about that you're still in that 4-decade low of unemployment rate. So yes, we can go back and forth, but we still think that 5.5 was very, very restrictive. 4.5, 4.25, 4.5 is right in the middle at the moment, not the easing policy that some market participants might be alluding to at this point. And yes, there is slightly more overexuberance in our point of view about the pro-growth policies that the market is worried about, or the pro-inflation policies the market is worried about. I think the administration still clearly needs to watch the 20 and 30-year part of the yield curve in the U.S. to make sure that they are not overdoing it from a policy perspective.
Was it appropriate that some members of the FOMC took Trump's policies of 2025 on board while others didn't?
Yes, I mean, like, that is your independence of each sort of Fed member. We saw very clearly one dissent coming out from the new member who joined in, as well as then 4 other dissents that showed up in the dot plot, if you will. So that tells you, even within the Fed, I think there is quite a bit of that independent thinking, independent viewing. And I think that there is still a lot of known unknowns from this policy. We know the 4-point agenda from the administration, but I think we also very clearly know that the math from the deficit situation is not going to allow those policies to be effectuated at the same rate or at the same magnitude. So, yeah, I think slightly inconsistent in terms of how the independence came through in the policy rate, slightly or very clear in terms of the push and pull that's why that last 25 basis point of cut was not as clear to us and the market. But I think the forward-looking, the market is slightly ahead of itself in completely pricing out the Fed at this point.
All right, Vishal Khanduja of Morgan Stanley, thank you so much. And a reminder, by the way, Anne-Marie, you brought this up. There is a 2-year yield auction, or 2-year auction, I should say, at 1 p.m. today.
At 1 p.m. today, yeah. Markets are still open. I know everyone is excited about Christmas and the holidays, but there is going to be a bond auction today, and then we're back on tomorrow and Thursday.
We are. And so let's count you down to the opening bell with just over a half an hour to go before the start of cash trading. Here's the trading diary for the week. Today at 10 a.m. Eastern time, so 30 minutes after the market opened, we'll get the Conference Board's consumer confidence as well as new home sales. And whether they move the market, these are probably like second-tier data points, so probably not as much. And tomorrow, you're off tomorrow, aren't you?
I'm off tomorrow.
Okay,
you're here.
Good for you. Get some rest. U.S. markets are open for half a day. Equities closing at 1 p.m. And for a change, the bond market will be closing later than equities at 2 p.m. So certainly watch for our coverage here on Bloomberg Television. No trading and therefore no Bloomberg Television on Wednesday, at least live coverage from New York.
Merry Christmas.
For the Christmas holiday. Merry Christmas. Thursday, you will be back.
I will be back for jobless claims. Can't miss jobless claims.
Yeah, high frequency data point. And as Vishal mentioned, certainly the labor market may not be out of the woods completely just yet.
Exactly.
Coming up tomorrow, we've got a lineup that you'll not want to miss. Stuart Kaiser of Citi, RJ Gallo of Federated, Hermes, Ryan Peterson of Flexport, and Stephanie Roth of Wolf Research, talking about the economy, talking about equities. Lots to discuss here as we see equity futures currently indicating a mixed open. NASDAQ futures are higher, but S&P futures are lower. Yields are moving higher right now, and oil prices lower by 0.4%. And we're looking, of course, at Eurodollar now above 104. We've paired some more losses.
Look at that.
This is Bloomberg Surveillance. Good morning, everyone.